Let's continue our marathon with the next chapter, Prospectus and Allotment of Securities. The expected weightage of this chapter in your examination is 6 to 8 marks. Difficulty point of view, this chapter is simple chapter, so don't ignore this chapter. Everyone prepare this chapter. And in this marathon, I am going to cover the following areas in this chapter. Basics, types of prospectus, misstatements in prospectus, allotment of securities, private placement of securities, and finally, global depository receipts. This chapter is covering 20 sections, section 23 to section 42, and this chapter is divided into two parts. Part 1, public offer, part 2, private placement. So here I'll start my marathon with section 23. Sir, what is section 23? Issue of securities. Section 23 is all about issue of securities. Public companies can issue securities to public through prospectus. Public company can also issue securities to identified persons through private placement. Public company can also issue securities to its existing members through rights issue or bonus issue. Now coming to private company can issue securities to identified persons. As you all know, private company is prohibited from offering securities to public. So private company can issue securities to identified persons through private placement, and private company can issue securities to its existing members through rights issue or bonus issue. Is it clear? Next one, new amendment newly inserted, new point. So the point is prescribed class of public companies. Prescribed public companies can issue securities and can list securities on foreign stock exchanges. Prescribed public companies can issue and list their securities on foreign stock exchanges. Is it clear? And in section 23 there is one more point, last point, section 23 subsection 4, powers of central government. Central government may exempt few companies from the provisions of chapter 4, share capital and debentures, provision section 89, section 90 and section 127. So these are the powers of the central government. Central government from time to time by way of notification can exempt prescribed companies from complying the provisions of chapter 4, share capital and debentures, section 89, section 90 and section 127. So this is all about section 23, issue of securities. Clear? So section 23, public company, private company. Next, powers of central government. Next one, section 24. Section 24 is all about powers of SEBI and powers of central government. Section 24, powers of central government and SEBI. For this purpose, companies are classified into two types. Listed companies, other companies. In listed companies, the activities are classified into two types. One is issue and transfer of securities. Next one, non-payment of declared dividend. So these two activities with respect to listed company are administered by SEBI. All other activities or all other aspects of listed company and all other companies are administered by central government. Very simple. Section 24, companies classified into two types, listed company, other companies. All aspects of other companies are administered by central government. Now coming to listed company, activities two types. One is issue and transfer of securities, non-payment of declared dividend. Next one, all other activities. Issue and transfer of securities, non-payment of declared dividend related to listed company are administered by SEBI. All other aspects or activities of listed company are administered by central government. For example, A listed company wants to shift its registered office from one state to another state. In that case, approval of central government is required. It's not approval of SEBI. SEBI intimation is sufficient. Intimation to SEBI is sufficient, but approval of central government is required for shifting registered office from one state to another state. Are you getting my point, everyone? So this is all about section 24. Next one, securities definition. Just read it once more. Securities includes, so it is inclusive definition. First of all, security includes shares, scrip, stock, bonds, debenture, stock. So securities means not only shares. Security means not only shares. It also covers debenture stock, derivatives. Next one, units of collective investment scheme, security receipts under SARFAESI Act. SARFAESI means securitization and reconstruction of financial assets and enforcement of Security Interest Act 2002. Next one, units of mutual fund scheme. Next one, certificate or instrument issued to an investor by any issuer being a special purpose distinct entity which possesses any debt or receivable. Next one, government securities or such other instruments as may be declared by central government to be securities. So all these are covered under the definition of securities. So company issuing any of these securities to the public, prospectus is compulsory. Company issuing any of these securities to the identified persons, private placement is compulsory. Understood? Next important point, very important point you have to remember, that is securities does not include unit linked insurance policy. So the definition of security excludes unit linked insurance policy. Remember this point, everyone. So chance of getting this question in multiple choice question is there. Understood? So securities excludes unit linked insurance policy. Next one, yes, I explained this chart ma. Issue of securities by public company, by private company. Next one, listed company. Listed company means what? A company which has any of its securities listed on any recognized stock exchange. Just now we've seen the definition of securities. Some 10 items are there, 10 plus items are there. So any company which has any of its securities listed on any recognized stock exchange, then that company is treated as listed company. So not only equity shares. Suppose company listed debentures on NSE, National Stock Exchange. Now also it is a listed company. Understood? So any of its securities listed on any recognized stock exchange, then company is considered as listed company. However, following companies are not categorized as listed companies. Following companies shall not be considered as listed companies. That means even though its securities listed on recognized stock exchange, still they are considered as unlisted companies. Sir, what are those companies, sir? First one, public company which have not listed their equity shares on a recognized stock exchange, but have listed their non-convertible debt securities which were issued on private placement basis. Non-convertible redeemable preference shares which were issued on private placement basis. So if you observe this point carefully, first of all, the public company, its equity shares were not listed. Its equity shares were not listed. Now what securities were listed? Non-convertible debt securities or non-convertible redeemable preference shares. These non-convertible debt securities, non-convertible redeemable preference shares were issued on private placement basis. Suppose if these securities were issued on public offer basis, prospectus basis, then that company is treated as listed company. Then that company is considered as listed company. A public company which has not listed its equity shares, which has not made a public offer, and which has issued securities on private placement basis. Now these securities, if they got listed on recognized stock exchange, that company, that public company is not treated as listed company. Sir, first of all, what are those securities? Non-convertible debt securities or non-convertible redeemable preference shares. Suppose if company lists convertible debt securities which were issued on private placement basis, then it will be considered as listed company. Why? Convertible debt securities at one point of time, they will be converted into equity shares. Understood? So public company which has not listed equity shares on recognized stock exchange but listed their non-convertible debt securities, non-convertible redeemable preference shares which were issued on private placement basis, then such public companies are not considered as listed companies. Next one, private companies. which have listed their non-convertible debt securities which were issued on private placement basis. Such private companies are not considered as the listed companies. Understood? Next one, public companies which have not listed their equity shares on recognized stock exchange, but whose equity shares are listed on a stock exchange in a jurisdiction as specified in subsection 3 of section 23 of the Act. Just now I told you, section 23, new amendment, new point was inserted. Prescribed public companies can issue and list their securities in foreign stock exchanges, on foreign stock exchanges in foreign countries. Such public companies are not considered as listed companies. Understood? Any public company which has not listed their equity shares in India, but which has listed their equity shares outside India, foreign countries, on foreign stock exchanges, then such public companies shall not be considered as a listed company. Understood? Everyone, listed company definition is very simple. Listed company means a company which has any of its securities listed on any recognized stock exchange. Definition is simple. Exclusions you have to remember. Exclusions is difficult point. Exclusions, public company which has not listed equity shares on recognized stock exchange in India. However, they listed their non-convertible debt securities, non-convertible redeemable preference shares which were issued on private placement basis. Then such public companies are not treated as listed companies. Next one, private companies. Private companies which have listed their non-convertible debt securities on private placement basis is also not considered as listed company. Next, public company which has not listed equity shares in India but listed their equity shares on a stock exchange in a jurisdiction specified in section 23 subsection 3, then also such public companies are not treated as listed companies. Next one, definition of prospectus. Definition of prospectus. Prospectus definition, two parts. Prospectus means any document prescribed or issued as a prospectus. Any document described, any document described or issued as a prospectus, it is a prospectus. So by name you can judge whether the document is prospectus or not. So on the document, if you find the name prospectus, it is a prospectus. And prospectus includes a shelf prospectus, a red herring prospectus, any notice, circular, advertisement or other document inviting offers from public. So here the name is not important. In this case, name is not important. You are issuing a document with the name notice or name circular or name advertisement. So why you are issuing that notice, sir? With an intention to invite offers from public for purchase or subscription of securities of the company. Then the document, even though the document name is notice, circular, advertisement, it is deemed to be prospectus. Are you all getting my point, students? So prospectus definition, it covers two aspects. One is means, the other one is includes. Prospectus means any document described or issued as a prospectus, it is a prospectus. Next, prospectus includes a shelf prospectus, red herring prospectus, notice, circular, advertisement or any other document inviting offers from public for subscription or purchase of any securities of body corporate. Then also the document is treated as prospectus, deemed to be prospectus. Understood? Next one, section 26, matters to be stated in prospectus. Matters to be stated in prospectus and requirements to the prospectus. Requirements as to the prospectus. Every prospectus shall be dated and signed. So without a date, the prospectus is not a valid prospectus. Without signature of the persons authorizing issue of prospectus, then also prospectus is not a valid prospectus. So first of all, it should be dated and it should be signed. And it shall contain such information and reports on financial information as may be specified by SEBI in consultation with central government. So SEBI regulations prescribes the matters, prescribes the information that to be furnished in the prospectus. Now you have to furnish that information in the prospectus. Understood? So Companies Act is giving reference to SEBI. SEBI is giving reference to SEBI regulations. Now whatever matters stated in the SEBI regulations that is to be furnished in the prospectus, you need to provide that information in the prospectus. In addition to that information, prospectus shall contain a declaration about compliance of the provisions of this act. So declaration is with respect to these three acts. None of the provisions of these three acts have been violated. None of the provisions have been violated while preparing and issuing this prospectus. So nothing contained in the prospectus, the point is nothing contained in the prospectus is contrary to the provisions of Companies Act, the provisions of Securities Contract Regulation Act, the provisions of SEBI Act, and the rules and regulations made above three statutes. Being a company, I should follow Companies Act. I'm issuing securities to the public, SEBI. Subject matter is securities, so Securities Contract Regulation Act 1956. So prospectus shall contain a statement stating that nothing in the prospectus is contrary to provisions of Companies Act, Securities Contract Regulation Act, SEBI Act, and the rules and regulations made under above three statutes. Next one, prospectus is not required in the following cases. So what are those following cases? When an offer is made to the existing members, existing debenture holders, prospectus is not required. Or when an offer is made to subscribe for shares or debentures which are uniform in all respects with the shares or debentures previously issued and dealt in, quoted in recognized stock exchange. That means the shares which we want to offer to the public is similar to the shares which were previously issued in all aspects and they are dealt in recognized stock exchange. That means, previously we brought one class of securities. Out of that, we already issued 95% to the public, and all those securities were already listed on recognized stock exchanges. Now balance 5%. If company is offering balance 5% to the public, in that case also prospectus is not required. When an offer is made to the existing members, prospectus is not required. When an offer is made to subscribe the securities which are existing securities which are dealt in recognized stock exchange, then also prospectus is not required. Next one, no offer or invitation is made to the public. Yes, in case of private placement, we are not making offer to the public, so prospectus is not required. Also, when shares and debentures are issued by a private company can't issue securities to the public. Private company is prohibited from issuing securities to the public. You look into the definition of private company. Prohibits offer of securities to the public or inviting public for subscribing the securities of the private company. The condition is there, understood? So private company is prohibited from issuing securities to the public. So when an offer is made by private company to the identified persons or to its existing members, then also prospectus is not required. Actually, these 2 points are relevant. These 2 points are important, 2 points are relevant. One is when offer is made to the existing members, existing debenture holders. Second one, offer is made to subscribe for the shares or debentures which are uniform in all respects with the existing shares or existing debentures which were previously issued and they're already listed in recognized stock exchanges. Understood? Next one, date of publication. So I told you every prospectus shall be dated, right? So date indicated in the prospectus shall be the date of its publication. But before you issue prospectus to the public, one copy of prospectus shall be filed with ROC. Understood? One copy of prospectus shall be filed with ROC. So delivery is sufficient. No need to register prospectus with ROC. Previously, before amendment, registration of prospectus with ROC is compulsory. Right now, registration is not required. Just file a signed copy of prospectus with ROC. Next one, expert statement. Sima, who is preparing prospectus? Management. Who is carrying business operations? Management. So management, which is carrying business operations, prepared prospectus. Now, the reader of prospectus will have a trust concern, will have a trust issue. Why? Business is carried by management and the prospectus is prepared by management. So how far I can trust this prospectus? So in order to eliminate trust issue or in order to enhance the trust, among the readers of the prospectus, generally companies include expert statement. Understood? Now, to include expert statement, company is required to satisfy the following conditions. So what are those conditions? Expert is not connected or not interested in the formation, promotion, management of the company. Expert is a person who is not connected or who is not interested in the formation or promotion or management of the company. Simply, expert should not be promoter of the company, or promoter cannot act as an expert. Next one, expert has given his written consent to issue of prospectus. So he should give no objection certificate. Yes, you can include my statement in the prospectus. And he has not withdrawn such consent before delivery of copy of prospectus to the registrar. That's it. So eliminate these words, printing error. So he has not withdrawn such consent before delivery of copy of prospectus to the ROC, and a statement to that effect shall be included in the prospectus. Simply disclosure. So what are the conditions a company should satisfy to include expert statement? First one, expert is not connected with or interested in the formation or promotion or management of the company. Next, he should give written consent to include his statement in the prospectus, and he should not withdraw such consent till company file a copy of prospectus with the registrar, and a statement to that effect shall be included in the prospectus, nothing but disclosure. If company satisfy these conditions, then company can include expert statement in the prospectus. Next one, prospectus generally have a limited validity period, that is 90 days. Once you file a prospectus with ROC, within 90 days, you should publish prospectus. After 90 days, that is no more a valid prospectus. Once again, you need to prepare updated prospectus. Once again, you need to file with registrar, and once again, you should go with the public offer. Understood? So prospectus is having a limited validity period, that is 90 days. Next one, disclosures on the prospectus. Disclosures on the face of prospectus. Yes, on the prospectus, 3 points should be disclosed. One is inclusion of expert statement, already completed. Next one, a copy of prospectus has been filed with the registrar. Next one, and specify the documents that are attached with the prospectus. For example, expert consent, next underwriting commission agreement, etc. Punishment in case of contravention. Any violation of section 26, company, the punishment to the company is 50,000 rupees to 3 lakh rupees. And the person who has authorized issue of prospectus, he will get a fine of 50,000 rupees to 3 lakh rupees. Simple punishment, contravention of section 26, company as well as officer who is in default. That means persons who has authorized issue of such prospectus negligently will get this punishment, 50,000 to 3 lakhs. Next one, issue of securities in demat form, dematerialized form. Companies, two types, public company, private company. Public company, again two types, listed public companies, unlisted companies. Listed companies can issue securities only in demat form. Demat form is compulsory. Listed companies can offer securities only in demat form. Demat form is a form which is not in material. Suppose, yes, you can see, suppose this is a material form. This book is a material form. Understood? And if this book soft copy is there, then we call it as demat form. For example, the file you are viewing, prospectus and allotment of securities document is there, right? On the screen, you can see the chapter. This is said to be in demat form. And the book in your hands is in material form. Understood? Understood. Something which is having physical appearance, physical substance, material form. 10 rupee note or 100 rupee note in your pocket is material form. Same 100 rupees in your bank account is demat form. Clear? So public companies, listed public companies can offer securities to the public only if those securities are in demat form. Next one, unlisted companies. Unlisted companies are also required to convert their physical securities into demat form of securities. So, sir, what is the time limit, sir? There is no time limit actually. But before making buyback of securities or before offering securities under rights issue or bonus issue, unlisted public companies are required to convert their physical material securities into demat form of securities. If public company, if unlisted public company is not converting material securities into dematerialized form of securities, then such public companies, unlisted public companies, are prohibited from making buyback of securities. Issuing securities under rights issue, issuing securities under bonus issue. Are you all getting my point? And it's not only the responsibility of company to convert securities into demat form, it is also the responsibility of existing shareholders, existing security holders. If existing security holders want to subscribe additional securities, if existing security holders want to transfer existing securities, in that case, it is the duty of existing security holders to communicate with company and to convert those securities into demat form of securities. So for such conversion, first of all, unlisted public company has to file an application with the depository. So depository shall facilitate a dematerialization of its existing securities by allocating ISIN number, International Security Identification Number. Natural persons like we have Aadhaar card. Yes or no? Unique number. Same number is not given to two or more persons. Unique number is given to each and every person. For securities also, identification number is there. International Security Identification Number. Understood? Everyone. Everyone. Next one, obligations of such unlisted public companies. Yes, before converting material form of securities into demat form of securities, first they need to file an application with the depository, and they need to enter into an agreement with the depositories. Next one, registrar to issue, and next one, share transfer agent. Why? So from now onwards, after conversion into demat form, all the transfers, issues, buybacks will happen only through online. Understood? Everyone. Next one, for that you need to maintain a security deposit with these people not less than 2 years fees. Suppose annual fees is 10 crore rupee, or sorry, 5 lakh rupee. If annual fees is 5 lakh rupee, then you need to maintain a security deposit of 2 years fees. 2 into 5 lakhs, that means 10 lakhs. 10 lakhs you need to deposit, and every year you need to pay fees. If you fail to pay fees, then these people will stop rendering services to you. In that case, you are prohibited from making buyback of securities, making further offer of securities, making a bonus issue, making rights issue. Understood? And every 6 months, after completion of 6 months, within 60 days, such unlisted public companies has to file PAS6 with ROC. PAS6 is for reconciliation of share capital audit report. Now April to September, 6 months completed. So from 30th September, within 60 days, file PAS6 with ROC. PAS6 is for reconciliation of share capital audit report. Clear? Next one, other than above companies, that means private companies. Other than above companies means private companies. Next one, nidhi companies, government companies, wholly owned subsidiary companies. So 4 companies: private companies, nidhi companies, government companies, wholly owned subsidiary companies. These 4 companies, if they want to continue their securities in material form, they can continue. Or if they want to convert them into dematerial form, they can convert. Option is given to them only. Listed companies, mandatory. Unlisted public companies, mandatory. What is mandatory? Mandatory with respect to what? Mandatory is with respect to conversion of material form of securities into dematerialization form of securities. Understood? Everyone. With this section 29 also completed. Next is section 30, advertisement of prospectus. Advertisement of prospectus. See, advertisement of prospectus is not compulsory. However, company wish to advertise its prospectus, then that advertisement shall contain following aspects. Once again, I am telling you, advertisement is not compulsory, but company wants to advertise its prospectus. In that case, that advertisement shall contain following contents: objects of the company, liability of the members, whether it is limited or unlimited, limited to the extent of unpaid value, limited to the extent of guarantee, furnish that point. Next one, what is the authorized share capital of the company? Next one, names of signatories to the memorandum, association clause, subscription clause in MOA, furnish the details of subscription clause. That's it. Number of shares subscribed by the signatories. So these 2 questions will be answered by subscription clause in MOA. Next one, capital structure of the company. So capital component, how much, debt component, how much, equity share capital component, how much, preference share capital component, how much. So furnish that information. The advertisement is not mandatory, but if company wish to advertise, then that advertisement should contain following 5 contents: object clause, liability clause, share capital clause, subscription clause, and finally capital structure of the company. So with this basics completed, so tell me what I covered in the basics heading. The definition of prospectus, issue of securities, requirements as to the prospectus, demat form of securities, advertisement of prospectus. So these 5 topics I covered under basics. Next one, types of prospectus. Here I am going to cover 5 different types of prospectus. One is self prospectus, rendering prospectus, deemed prospectus, offer for sale of securities, abridged prospectus. Important area. You can expect one question from types of prospectus. In this first one, shelf prospectus. Shelf prospectus means a prospectus in respect of which the securities or class of securities included therein are issued for subscription in one or more issues over a certain period without issue of further prospectus. Suppose, company issued prospectus at this point, shelf prospectus. And company made first public offer here itself. First public offer with respect to this shelf prospectus has been made at this point of time. Now this prospectus will have a validity of 1 year, a limited period, 1 year. So 1 year validity means what, sir? What it indicates? During this 1 year, a company can make public offer of these securities n number of times without issuing further prospectus. Suppose company decided to make 5 more public offers under this shelf prospectus. Is it possible, sir? Yes, possible. Provided all these public offers should be done within 1 year. All these public offers should be should be made within 1 year from the date of first public offer under that prospectus. Are you all getting my point, students? So shelf prospectus, what is the validity of shelf prospectus? 1 year. Many will remember 1 year, but 1 year starts from which date? Many of you will not remember that point. 1 year starts from 1 year starts from the date of opening of first offer of securities. So here date of issue of shelf prospectus, date of filing of shelf prospectus with ROC is immaterial. Here the commencement date is when first public offer of securities was made under that shelf prospectus is important. From that point onwards, 1 year. So for second or subsequent offer of such securities issued during the period of validity, no further prospectus is required. Understood? But the main objective of issuing prospectus is to communicate the public about the various aspects of the company. In that case, company should give updated information. Yes or no? Company should give updated information. At this point of time, whatever shelf prospectus issued some 3 months back or 2 months back, it gets outdated. Yes or no? Shelf prospectus is updated one at this point of time, but coming to this point, yes, shelf prospectus is an outdated one. So to update that shelf prospectus, what does Ministry of Corporate Affairs, what Companies Act is expecting from us, during this period, whatever changes happened in the financial position of the company, Next one, whatever new charges created during this time period, provide this information in a document called information memorandum. Now a person subscribing securities at this point, he should read not only shelf prospectus but also information memorandum. Now shelf prospectus and information memorandum put together constitute prospectus under section 26. Are you all getting my point? Information memorandum shall contain the changes in the financial position of the company, from the date of shelf prospectus to the date of second or subsequent public offer, and any new charges created during this time period, and such other material information which can influence the decision making of the reader of prospectus. So furnish that information in information memorandum. And filings with ROC, it is compulsory. So before making public offers, yes, definitely you need to file a copy of documents with a registrar. So filing with ROC. Next one, filing of information memorandum. Shall contain material facts relating to new charges created, changes in the financial position of the company that occurred between first offer of securities and succeeding offer of securities. And one important note point is there, Suppose any person who has made an application in advance who has made an application in advance, he shall be given an opportunity to withdraw. Suppose one person filed an application in advance. We didn't give any information memorandum. He deposited money in advance. Of course, company can't use that money. Company has to keep that money in separate bank account. So subsequently, company came with a new public offer. One more public offer. At that point, company has to give information memorandum, and it has to give information memorandum to this person. And if that person wish to continue with company, then company can make allotment of securities in that person name. Suppose if that person decides not to continue with company, then he can withdraw his application. In that case, company has to refund the money received, which is in advance as subscription within 15 days from availing the option. Understood? So when company receives any money in advance, company receive any application in advance before making subsequent or second or subsequent public offers. In that case, an intimation as well as opportunity to withdraw shall be given to those persons. If they wish to continue, then allotment can be done. If they want to withdraw, then company has to refund those monies. Company has to refund those monies within 15 days. This shelf prospectus completed. In one attempt, I still remember, in one attempt, a question was asked like this. Information memorandum along with a shelf prospectus. Information memorandum together with shelf prospectus shall be deemed to be a prospectus comment. Question came for 4 marks, I guess. 4 marks. So they asked this one point. And students confused looking at this question. So what examiner, what ICA is expecting? ICA is expecting to write a deemed prospectus section 25 or shelf prospectus section 31. So many students confused after reading that question. So the actual answer is shelf prospectus section 31. Yeah, question came like this only. Information memorandum together with shelf prospectus shall be deemed to be a prospectus comment. 4 marks. Now you need to write this entire answer. Shelf prospectus completed. Next one, red herring prospectus. Generally, prospectus should contain complete information and correct information. Complete and correct. But here, the issuer company is not having information regarding price of securities, issue price. Next one, quantum of securities to be offered to the public. The issuer company is not sure, or issuer company is not having information related to price of securities and the quantum of securities. In that case, issuer company, company can issue incomplete prospectus. That incomplete prospectus is nothing but red herring prospectus. The red herring prospectus is useful in book building process. When company is not sure or company is not having clear cut information regarding price, then it can ask public to fix the price. For that, company will fix a price band. For example, 200 rupees to 205 rupees. Interested applicants can file an application with a price which shall not be less than 200, not more than 205. Now at what price, company is receiving more number of applications, company will fix that price and company will fix the quantum of securities. Now with this complete information, company has to prepare one more prospectus which is known as final prospectus. So under red herring prospectus, you will find 2 prospectus. One is red herring, the other one is final. One is issued before public offer, the other one is issued after making public offer but before making allotment of securities. Are you all getting my point, students? Generally, prospectus is valid for 90 days. To this point, we had one exception, that is shelf prospectus. Shelf prospectus is having a validity period of 1 year from the date of first public offer under shelf prospectus. Next one, prospectus shall contain complete information. To this point, we had one exception, that is red herring prospectus. Are you all getting my point, students? So red herring prospectus means a prospectus which does not include complete particulars of quantum of securities, price of securities. Now, file a red herring prospectus with a ROC at least 3 days prior to opening of subscription. Normal prospectus, before making public offer, before making publication, you need to file a copy with registrar. But coming to red herring prospectus, at least 3 days before opening the subscription list, So that means, opening the subscription list means, during that period, company can receive application money. So before opening subscription list, at least 3 days before, file a copy with the registrar. And red herring prospectus shall carry the same obligations as are applicable to a prospectus. That means section 26 is completely applicable to red herring prospectus. Next one, preparation and filing of final prospectus with registrar and SEBI upon closing of the offer. That's what I told you. Before making public offer, here we'll issue red herring prospectus. After public offer, but before making allotment of securities, we'll prepare and file final prospectus. Understood? This final prospectus will contain information regarding issue price and quantum of securities. Clear? Next one, abridged prospectus. Actually, this is not one type of prospectus. This is not a type of prospectus. In fact, this is something attached to the application form. This is attached to the application form. Generally prospectus is of some 400-500 pages document. 400-500 pages document. It is not possible to circulate that much bulky document among the public. So that's why what lawmaker is asking company. Company, whatever prospectus you prepared, out of that, extract key information, extract material information. Take material information, an information which can influence the decision making of the investor. Find out that information, find out the key information, and publish that information in a separate document called abridged prospectus. This is like fast track prospectus. This is like a summary of main prospectus. Don't write in exam fast track summary. Don't write. For your understanding, I'm telling you, abridged prospectus is like summary to the main prospectus. Abridged prospectus means memorandum. It's not a complete prospectus. It's a memorandum containing salient features of the prospectus, key features, material information of the prospectus, as may be specified by SEBI by making regulations in this behalf. And company has to issue this abridged prospectus along with application form. Interested applicants will file application, right? Yes or no? No, they need to fill application form. Yes or no? No, that application form shall not be issued individually. That application form shall be accompanied with abridged prospectus. Understood? Everyone. So application form shall not be issued individually. It shall be accompanied with abridged prospectus. And this abridged prospectus is not required in following 3 cases. One is when an invitation is made to the underwriters for entering into underwriting agreement, when an offer is not made to the public, or when an offer is made to the existing members. Technically, rights issue. In case of rights issue, abridged prospectus not required. In case of private placement also, abridged prospectus is not required. And we are making an advertisement inviting underwriters to enter into an underwriting agreement with respect to shares or debentures. In that case also, abridged prospectus is not applicable. Come on, tell me, what are those 3 cases where abridged prospectus is not applicable? Not applicable. Come on, tell me. 3 cases. Underwriters, inviting underwriters to enter into an underwriting agreement. Next one, private placement. Last one, rights issue. In these 3 cases, abridged prospectus is not applicable. Now, any applicant going through the abridged prospectus and he got some doubt or he wants some additional information. In that case, he can request company for complete, for full prospectus. So that request should be made within a reasonable time. That is, before closing of subscription list. And it is the duty of company to furnish full prospectus to the requested person. In case company make any violation, if company commits any violation, that means application form is not accompanied with abridged prospectus. What? Application form is not accompanied with abridged prospectus. Next one, a person requested for full prospectus, but company failed to furnish full prospectus to that person. In these 2 cases, company will get a punishment. So what is the punishment? 50,000 rupees for each default. Company, any default in complying with provisions of section 33 shall be liable to a penalty of 50,000 rupees for each default. Understood? Everyone. Right now, prospectus, application form, everything is made available in online. So simply one click you can download complete prospectus. One click you can download application form. You can fill application form. You can upload it, or you can file. You can fill application online. Are you getting my point? So previously these provisions played a significant role. Right now, not that much significant. Why? If you want, you can download complete prospectus from SEBI website, authorized websites. Okay. Next one, deemed prospectus. Deemed prospectus. Listen to me carefully. Company, public. Company is making allotment, or company is making an agreement to allot. Agreement to allot securities in the name of a person. I call that person as issue house, with a view or with an intention to offer the same securities to public. Observe carefully here what company is doing. First, company is making allotment of securities, or company is entering into an agreement to allot securities in the name of issue house with a view or with an intention to transfer or offer the same securities to public. Generally, if company is making offer to public, in that case, prospectus is compulsory. Yes or no? Company can't issue securities to public without prospectus. To avoid this, what company will do? Under private placement, company will allot securities in the name of one person, and that person will further transfer, for further offer shares to the public. Now here company is not directly making public offer to public, therefore company avoids the provisions of part 1 of chapter 3. So to avoid such situation, to cover that loophole, lawmaker came up with the deemed prospectus concept. So here, when an issue house is making an offer of securities to the public, we can assume that it is a deemed public offer. We can assume it as a public offer, deemed public offer. But this assumption is valid only in two cases. Case 1, when an issue house is making offer within 6 months from the date of allotment or agreement to allot. If issue house is making an offer to the public within 6 months from the date of allotment or agreement to allot, then in that case, that public offer is deemed to be public offer, and the document is deemed to be prospectus. That offer document is deemed to be prospectus. This is one case. And the other case is, at the time of making public offer, whole consideration has not been discharged. I'm not telling whole consideration is pending. I'm telling that whole consideration not discharged. Suppose the deal amount is 10 crores. Offer value is 10 crores. Issue house already paid 9 crores 90 lakhs. Only 10 lakhs is pending. In that case also, whole consideration is said to be not discharged. Understood? Everyone, come on, tell me when deemed prospectus is applicable. A company is making allotment of securities or entering into agreement to allot securities in the name of a person who further makes an offer to the public, or with a view or with an assumption or with an intention to offer same securities to public. In that case, offer to the public is deemed to be public offer, and the document issued to the public is deemed to be prospectus. Understood? Suppose issue house is making an offer to public after expiry of 6 months, and at the time of making such offer, whole consideration had been discharged. In that case only, it is not deemed to be public offer. In that case, deemed prospectus is not applicable. Come on, tell me the cases where deemed prospectus is not applicable. Only one case. That one case is offer made after 6 months of allotment. At the time of making offer, the whole consideration between issue house and company has been discharged, settled. In that one situation, deemed prospectus will not come. In all other situations, deemed prospectus will come. Just observe the point here. Document by which offer for sale to the public is made shall be deemed to be prospectus issued by the company. Where a company allots or agrees to allot any securities with a view or with an intention to securities being offered for sale to the public, then any document by which offer for sale to the public is made shall be deemed to be a prospectus issued by the company. And all the provisions relating to the prospectus shall apply. All the provisions relating to prospectus shall apply. Misstatement section 34, 35. Next one, section 26, filing of prospectus with ROC. All these provisions will apply. An allotment or agreement to allot securities will be treated as public offer if it is shown that offer was made within 6 months or at the date when public offer was made, whole consideration to be received by company in respect of securities had not been received by it. So in these two situations, the public offer is the offer of securities shall be treated as public offer. Accordingly, the document issued with respect to offer is deemed to be prospectus. Now, looking at contents of the deemed prospectus, what are the contents you need to provide in the deemed prospectus? First, contents as specified in section 26, that means SEBI regulations. Contents specified in SEBI regulations. In addition to that contents, two more points you have to provide. Information related to two aspects you need to provide. Sir, what are those two aspects? Net amount of consideration received till date to be received by the company in respect of such offer of securities, and time and place for inspection of contract between company and issue house. Section 26 contents, follow it. Provide the contents specified in section 26. In addition to those contents, you need to provide two more contents. One is net amount of consideration received or to be received by the company, and time and place for inspection of the contract that was made between company and issue house. Next one, deemed directors. Generally, prospectus shall be signed by the directors of the company. In this case, prospectus shall be signed by issue house, intermediary. Understood? If issue house is a company, then two directors shall sign this deemed prospectus. If issue house is a partnership firm, if intermediary is a partnership firm, then not less than one of the partners in the firm should sign this document. Everyone. Sima, prospectus and the allotment of securities, regular class, I thought almost 9 hours. Since this is a marathon, I can't revise it more and more number of times. Marathon lectures just confirms the points which you already know. Marathon is just a confirmation aspect. It's not a learning one. So before listening to marathon, I hope everyone had read this chapter, everyone understand this chapter. This is just a revision. Through marathon, you can confirm the content which you already know. That's it. So just watching marathon, understanding the provisions, learning the provisions is not at all possible. I hope everyone understood this point. So some students may think sir is very fast, or sir is covering a complete content within short time. Yes, this is a marathon, so I should cover majority content within the limited time. Understood? So that is the only difference between marathon and regular class. In regular class, you can learn, you can revise. Coming to marathon, only revision aspect. So don't come to the conclusion. The conclusion is learning from marathons is not at all possible. Revision with marathons is possible. Next one. Offer for sale by members of the company to the public. A very simple point. Company, existing members. So here company, existing members of the company authorizing company to transfer their shares to public. So first, existing members will give shares to the company and will authorize company to transfer their shares to the public. Now, whatever offer is made by the company to the public for sale of securities, offer for sale of securities by existing members, sale of securities of, whose securities? Securities of existing members, then this offer is deemed to be public offer. Accordingly, here prospectus is compulsory. So the difference between, fresh offer and offer for sale of securities is, under fresh offer, company receive money, company will make allotment of securities. Company makes allotment of its securities and company will receive that money. Under OFS, offer for sale of securities, company will not issue its securities, company will issue existing member securities. These securities were already allotted. These securities belong to the existing members. So company will take securities from existing members and company will offer same securities to the public. So here, company is just acting as an intermediary between existing members and new members. Understood? Company is just acting as an intermediary between existing members and new members. So with the help of company, existing members will offer their securities to the public. Understood? Everyone. And that offer is deemed to be public offer. Here also prospectus is compulsory. Where certain members of company propose to offer whole or part of their holdings of shares to the public, they may do so in accordance with such procedure as may be prescribed. Any document by which offer of sale to the public is made shall be deemed to be a prospectus issued by the company, and all laws and rules made thereunder as to the contents of the prospectus and as to the liability in respect of misstatements in and omission from prospectus shall apply. That means section 26, filing of prospectus with ROC, section 34, misstatements, criminal liability, section 35, misstatements, civil liability. All these provisions will apply to this prospectus too. Next one, members, whether individuals or body corporates, or both, whose shares are proposed to be offered to the public shall collectively authorize the company to take all actions in respect of offer of sale, and they shall reimburse the company all expenses incurred by it on this matter. So whatever expenses incurred by company in making the prospectus, filing with ROC, complying the directions of SEBI. So for all these things, whatever expenses incurred by the company, yes, members has to reimburse the company. So all the provisions are applicable except the following provisions: minimum subscription, minimum application value, and next provisions requiring any statement to be made by directors in respect of utilization of money. So these three aspects are not applicable. Why? The reason here, company is not making allotment of securities. Allotment means, appropriation out of unappropriated capital. It's a new capital. Out of new capital, company is making appropriation, that we call allotment. For making allotment, minimum subscription, minimum application value condition should be satisfied. How much is the minimum subscription? How much is the minimum application value? I'll discuss with you in section 39. Just wait for 5 minutes. I'll discuss with you minimum subscription, minimum application value in section 39. But the point here, company is not making allotment. Company is just transferring shares of existing members to new members. So no new allotment, no allotment at all. Since allotment is not applicable, minimum subscription, minimum application value are not applicable. And moreover, whatever money company is receiving from new members, it is completely returning that money to the existing members after reducing whatever expenses incurred by the company. So here, utilization of money statement is not required. Utilization of money statement is not required. If you ask company to give this information, what company will do? I collected 100 crores less 5 crores expenses, balance 95 crores paid to existing members. That thing already every person know, right? So no need to furnish this statement. Next one. So with this, types of prospectus also completed. Types of prospectus also completed. Next one, misstatements. First of all, misstatement means, I'm sorry, section 27 is there, right? Okay. Section 27, simple section. In Indian Contract Act, you studied one concept called novation. New contract in the place of old contract. Yes or no? So initially, with some terms and conditions, two parties entered into contract. Later, they want to change the terms and conditions. So change of terms and conditions in a contract is possible only with the mutual consent of parties. Yes or no? Only with the mutual consent of parties, terms and conditions can be changed. Now, allotment of securities. This is also a contract between two persons. Company, allottee. Company, investors. So there is a contract between company and investors. And the basis of this contract is prospectus. company told, I will utilize money for one purpose. Today, company left with some surplus funds. Company thought 100 crores is required for finishing the project. However, with 90 crores, company finished the project. Now, company is having 10 crores surplus funds. Now, company wants to utilize this 10 crores for some other purpose. Can it do so? The answer is actually no, but it wants to use the funds for some other purpose. First of all, it should get approval from the investors. General answer is no, but there is one exception. That exception is the terms and conditions can be revised with the mutual consent of the parties to the contract, right? So similarly here, company can use balance funds, or company can use funds that was raised through public offer. It can use those funds for other purposes only after taking consent from the members. And what type of consent is required, sir? Special resolution. Special resolution. Before getting special resolution, before calling for general meeting, yes, company has to dispatch notice. Company has to issue notice to the members. And in that notice, company has to furnish information regarding original purpose, original object of the issue, total money raised, total money utilized, and to what extent the proposed objects completed, 90% completed. Next one, what is the unutilized amount? How much amount is left over? And with that unutilized amount, yes, what company wants to do, what variation company is asking, and what is the reason of variation, and what is the proposed time limit within which the proposed the new objects would be achieved. Next one, clause wise details specified in sub rule 3, rule 3 as required with respect to originally proposed objects. So original contents of the prospectus, copy it, and the variation you are seeking, just furnish that information. Risk factors associated with new objects and any other related information, relevant information. So by providing this information, member of the company can make a valid decision. Member will take a valid stand and the member will cast a vote. If company gets special resolution, then company can utilize that funds for new objects. Of course, in case company, dissenting shareholders, in case of dissenting shareholders, company has to give exit offer to dissenting shareholders. Exactly, if you write like that, you'll get 0 marks. Company will not give exit offer to the dissenting shareholders. Exit offer shall be given by the controlling shareholders or promoters. In case of dissenting shareholders, suppose I need special resolution. Special resolution means votes in favor greater than or equal to 3 times votes against. Yes or no? Suppose I got approval from 90% of paid up share capital holders. Remaining 10% paid up share capital holders, they are against to the proposal. And these people are known as dissenting shareholders. In this case, the controlling shareholders or promoters shall give an exit offer. So they should convince dissenting shareholders. If dissenting shareholders are not listening, then they should pay amount to dissenting shareholders and they have to take these shares of dissenting shareholders. So transfer happens between promoter and dissenting shareholders. If company is making exit offer, we call it as buyback of securities. Section 68, 69, 70 provisions shall apply. So here exit offer shall be given by not company but by promoters, controlling shareholders. Everyone getting my point, students? So with that, variation completed. Next one, misstatements. Misstatement is nothing but providing inaccurate information, false information, or providing incomplete information. If you are providing incomplete information, that means omission of information, or if you're providing incorrect information, then we call it as a misstatement. So simple word. What is misstatement? Furnishing incomplete information or furnishing incorrect information. Both the cases we call it as misstatement. Now, what is the effect of misstatement, sir? What are the effects of misstatements? 2 effects. One is criminal liability, second one civil liability. Criminal liability. Persons authorizing issue of prospectus. Every person authorizing issue of prospectus, present directors or proposed directors, company secretary, CEO, CFO, whoever, the person who is authorizing issue of prospectus will get punishment under section 447, fraud punishment. So what is the punishment under section 447? I'll discuss with you. Just wait for 2 minutes. Okay. So impact of misstatement in the prospectus. First, criminal liability. Who will be punished? Every person who authorized the prospectus will get punishment. What is the punishment? Section 447 punishment. Defense. Suppose if he want to relieved or if he want to come out from this punishment. Sir, no, sir. For me, punishment is not applicable. Why? Sir, that misstatement is immaterial, sir. Suppose company turnover is 699 crores, 70 lakhs, 30,150 rupees. This is the turnover of the company. And director made a statement. The turnover of the company is 700 crores approx. 700 crores approx. This is, rounding of difference, and it is not material. It is not material. So, yes, if the misstatement is immaterial, or he has reasonable ground to believe that statement is correct. The burden of proof lies on these persons, whoever authorized the issue of prospectus and the prospectus containing a misstatement. So now the person, if he proves that misstatement is immaterial, or if he proves that, sir, at the time of issue of prospectus, till the time of issue of prospectus, the statement is correct. Subsequently, it went incorrect, sir. Subsequently, it went incorrect. So if he is able to prove any one of these grounds, then he will not get punishment under section 447. Clear? Next one. Civil liability. Civil liability. So under criminal liability, whatever amounts we are paying, it will be deposited to government account. It will be deposited to government account. Under civil liability, whatever amount we are paying, that amount shall be credited to suffered investors as a compensation. The investors who are at damages will get that amount. Understood? Civil liability, compensation to investors. Criminal liability, payment of fines to government. Understood? So here, company director, proposed director, promoter, expert, and the person one who authorized the issue of prospectus will get this punishment. The punishment is just compensate investors. Because of misstatement, investors suffered a loss of 6 crores. Come on, you all 6 people, company director, proposed director, promoter, expert, and a person authorized the issue of prospectus. Come on, you 6 people, compensate 6 crores. That's it. Defense, exemption. Following cases, you will not get this punishment. What are those cases? Sir, before issue of prospectus, I withdrawn my consent to be director, sir. I withdrawn my consent, sir. Without my consent, prospectus was issued. I gave public notice, sir. So don't believe that statement. I'm not a director. I'm not associated with that company prospectus. So give that public notice. Give public notice. Or, sir, I made a statement on the belief of expert statement. So expert made one statement, sir. On the belief of expert, I said the same statement. If I knew that expert is wrong fellow, I would not have given my consent, sir. On that basis also, you will get a exemption. Last one, issued without his knowledge, public notice given. Already I told you, right? In these 3 cases, a person can escape from punishment under section 35. Withdraw the consent. Suppose without your knowledge, your name was included in prospectus. Now give public notice. Next, or another case, sir, I believed expert, sir. I trusted expert. That's why I gave my consent to the prospectus. If I knew that expert is wrong person, if I knew that expert statement is wrong, I wouldn't have given my consent to the prospectus. If you are able to prove any of these 3 grounds, you'll get a exemption from punishment. Clear? Next, section 36, punishment for fraudulently inducing a person to invest money. Generally underwriters are, underwriters are like marketing agents. So they will promote, or they will so they will influence investors to make investment in the company. Underwriter, technically underwriter, but if you look into the market, underwriter is like a marketing agent. He will influence investors to invest money into the company. Now, if any underwriter is making a statement which is a wrong, which he is making a recklessly, and that statements are wrong, those statements are incorrect, in that case, the person whoever making such statements will get punishment under section 447. So what is section 447 punishment? What is section 447 punishment? Because of your statements in the prospectus, or because of your advertisements, if public interest is affected, in that case the punishment is imprisonment 3 years minimum, maximum 10 years, and fine amount, minimum amount involved in the fraud, maximum 3 times of the amount involved in the fraud. If public interest is affected, minimum 3 years imprisonment, maximum 10 years imprisonment, and fine, minimum amount involved in the fraud, maximum 3 times of the amount involved in the fraud. Is it clear? Sir, public interest not affected, sir. Public interest not affected, but amount of fraud is greater than or equal to fraud amount greater than or equal to 1% of company turnover or rupees 10 lakhs, whichever is lower. If amount involved in the fraud is greater than or equal to 1% of turnover or rupees 10 lakhs, in that case the punishment is 6 months imprisonment, 6 months to 10 years, and fine amount, minimum amount involved in the fraud, maximum 3 times of the amount involved in the fraud. So this is a case where no public interest. Suppose public interest is also there, sir. In that case, this 6 months, straight away 3 years. Sir, no public interest, sir. And amount involved in the fraud is less than 10 lakhs or 1% of turnover, whichever is lower. And this is a case where no public interest affected. In this case, the punishment is imprisonment up to 5 years or fine up to 50 lakhs or both. In the above cases, it is fine and imprisonment. But in this case, either imprisonment or fine or both. Clear? Everyone. Just listen to me carefully. Punishment for fraud. Public interest affected. So in this case, imprisonment minimum 3 years, maximum 10 years, and fine, minimum amount involved in the fraud, maximum 3 times of the amount involved in the fraud. Sir, no public interest, sir. No public interest. In that case, amount involved in the fraud, if it is greater than or equal to 1% of turnover or rupees 10 lakhs, whichever is less, in that case, imprisonment is for 6 months. Imprisonment is just for 6 months only. Maximum 10 years. So the only change if you observe, here it is 3 years, here it is 6 months. And here we are not required to check the quantum of the fraud, amount involved in the fraud. Public interest affected, straight away punishment. Public interest not affected, sir. In that case, 2 categories. Amount involved in the fraud. If amount involved in the fraud is less than 1% of turnover or rupees 10 lakhs, whichever is lower, in that case, imprisonment up to 5 years or fine up to 50 lakhs or both. Here I forgot to write one more point. And amount involved in the fraud, minimum fine, maximum 3 times of the amount involved in the fraud. So this is punishment for fraud under section 447. You just pause the video and copy the content. Next, actions that can be taken by affected persons. Small section only. See, because of misstatement in prospectus, lakhs of investors suffered. Lakhs of investors are at loss. In this case, each and every individual going separately and filing complaint on the company. Instead of doing this, all the investors, on behalf of all these investors, one can file a case against company. This is known as class suit, class action. Now, all other persons are not required to file complaints individually. So this helps in saving a lot of time in the court. Understood? Why? All these people, for example, 2 lakhs people are at loss because of misstatement in prospectus. Instead of filing 2 lakh cases, all these 2 lakh people, authorize one person, and that person will file a action. Sorry, that one person will file a case against company. Simply class action suit. We call it as class action suit. So with this, misstatements related content over. Misstatements related content over. Next concept is allotment of securities. Misstatements also over. Next one, allotment of securities. For making allotment of securities, yes, company has to satisfy some conditions. One is minimum subscription amount. Minimum subscription amount. Second one is minimum application value. Minimum application value. Sir, how much is the minimum subscription? As per SEBI, it shall not be less than 90% of public offer. As per SEBI, it should be minimum 90% of public offer. As per Companies Act, amount stated in prospectus as minimum subscription. Amount stated in prospectus as minimum subscription. So company should receive this much, these many applications. Company should receive these many applications. As per SEBI, how much? 90%. Suppose company is offering 1 crore securities. As per SEBI, 90 lakh securities. Company should receive application with respect to 90 lakhs. As per Companies Act, amount stated in the prospectus. Suppose in prospectus you told that 92% is my minimum subscription. In that case, 92% is the minimum subscription. Next, minimum application value shall not be less than 5% of face value. This is as per Companies Act. As per SEBI Act, 25% of issue price. Sir, now which one I should follow, sir? The listed companies only can make public offer. Listed companies with respect to issue of securities, they should comply SEBI. These aspects are administered by SEBI. Therefore, this one will apply. Are you getting my point? Now, company has to satisfy these two conditions within 30 days. Within 30 days of prospectus. If satisfied, condition satisfied, then make allotment of securities, and company has to file a written off allotment in form PAS3 with ROC. Within 30 days of allotment, company has to file PAS3 with ROC. Sir, conditions not satisfied, sir, then refund all those monies within 15 days. What is the duration? 15 days of closure of issue. The time of issue closure only you know whether you received minimum subscription, whether you received minimum application money or not. So within 15 days of closure of issue, refund all those monies. Sir, failed to refund. In that case, board of directors who are in default has to pay interest at the rate of 15% per annum. It's not company, it's board of directors. Board of directors have to pay interest at the rate of 15% per annum during that delay period. Are you all getting my point, students? Everyone? So that is all about minimum subscription, minimum application conditions. Allotment, I told you, allotment means appropriation out of unappropriated capital. That's why I told you under offer for sale of securities, it's not appropriation out of unappropriated capital, it's already appropriated capital. So allotment provisions shall not apply to offer for sale of securities. And through allotment only shares comes into existence. Next one, minimum subscription. I told you, minimum subscription, minimum application money. If allotment is done within 30 days of allotment, file PAS3 with ROC. Any violation, company as well as officer who is in default will get a punishment, 1000 rupees for each day, maximum 1 lakh rupees. Maximum 1 lakh rupees. Next condition before making a public offer is the securities which company is offering to the public must be listed on any recognized stock exchange. Understood? So company has to make an application with one or more recognized stock exchange or exchanges and obtain permission for securities to be dealt on those stock exchanges. And in that prospectus, company has to disclose the name of stock exchanges in which securities shall be dealt with. Understood? until company makes allotment, all the application money shall be kept in separate bank account. And that money can be used only for two purposes. One is adjustment against allotment of securities or refund of monies within the time specified by SEBI. One is if you make allotment, you can use that money. If you are unable to make allotment, refund all those monies within the timelines given by SEBI. And in prospectus, if there is a condition that waiver of compliance, suppose section 26 is not applicable to the company, section 34, 35 not applicable to the company. If you write such points and if you remove the rights of the investors, if you want to eliminate rights of the investors, such conditions, such content in the prospectus stands void. It's almost like agreement in restraint of trade, agreement in restraint of marriage. These agreements are void, yes or no? Here also, any agreement to waive compliance, stands void. Understood? Violation of section 40, company punishment 5 lakhs to 50 lakhs, officer 50,000 to 3 lakhs. Violation means, before making allotment, company started using money, or company is not refunding the money to the investors. In these cases, company punishment 5 lakh to 50 lakhs, officer punishment 50,000 to 3 lakhs. Next one, underwriting commission. Underwriting commission. So conditions for making payment of underwriting commission is authorization in AOA. Next one, sources. For payment of underwriting commission, company can use issue proceeds or company can use profits of the company. Sometimes both. One is AOA authorization, second one sources for payment of commission. Next one, rate of commission. How much, sir? Rate mentioned in AOA are 5% of issue price in case of shares. Rate mentioned in AOA are 2% of issue price in case of debentures. This is the maximum rate of commission a company can pay to the underwriters. In addition to that, furnish the details of underwriters and attach underwriter agreement to the prospectus. Understood? So when you are delivering prospectus to the ROC, you need to deliver underwriters agreement also. And one more important point, commission is not payable. Underwriting commission is not allowed on the shares which were not offered to the public. Suppose 20% of the shares subscribed by the promoters. Now on that portion, on the 20% portion, company should not pay underwriting commission to the underwriters. So with this, allotment of securities completed. So we are left with only two concepts. One is private placement. The other one is the global depository receipts. Section 42, private placement. Section 42, private placement. So meaning of private placement. Private placement means any offer or invitation to subscribe or issue of securities to a selected group of persons by a company through private placement offer cum application letter and which satisfy conditions specified in section 42. Important concept, ma. Important concept. Company. Next, identified persons. Identified persons. Sir, who will identify the persons, sir? Board of directors, ma. Board of directors. So company will issue private placement offer cum application letter to the identified persons. But before making that, before issuing that letter, first company should get approval. Approval from whom, sir? Approval from members by way of special resolution. In case of issue of equity shares or convertible debenture cases, convertible debentures. Next one, issue of non-convertible debentures where it is exceeding the limits of 100% of paid up share capital. Issue of NCDs. Here the point is existing borrowings plus new borrowings put together, if they exceed 100% of paid up share capital plus free reserves plus securities premium. In this case, one special resolution is required for every year before making private placement. Securities issued under private placement, if they are equity shares, if they are convertible debentures, then every time special resolution is compulsory. Sir, we are issuing non-convertible debentures, sir. Acha. Existing borrowings plus new borrowings put together, if they are within the limits of 100% of paid up share capital plus free reserves plus securities premium, board resolution is sufficient. Other cases, board resolution is sufficient. Suppose, existing borrowings plus new borrowings exceeds the 100% of paid up share capital plus free reserves plus securities premium. In that case, one special resolution for 1 year is required. So approving authority, approving authority. Once approval is received, then company can prepare this document and company can issue this document. These identified persons are maximum 200 persons maximum for every financial year, per financial year. Next one, per security. Suppose company is issuing 3 types of securities: preference shares, equity shares, debentures. Now it can make private placement up to 200 for preference shares, up to 200 for equity shares, up to 200 for debentures. So total 600. See, this limit 200 is per security, not per company. This limit is per security and per financial year. While counting these 200 persons, 2 people shall be excluded. One is qualified institutional buyers. The other one is employees under employee stock option or employee stock option plan, ESOP. So 2 people, qualified institutional buyers, employees, shall be excluded while counting 200. And these limits, exclusions are not applicable to NBFC companies, housing finance companies. Clear, everyone? And this private placement offer cum application letter, advertisement should not be done. Advertisement is strictly prohibited. So you cannot make advertisement of private placement. Next one, renunciation is also not there. Renunciation benefit is also not there. That means, if identified person is not willing to subscribe shares, if identified person want to transfer that offer to other person, we call it as renunciation, and this renunciation benefit is not there. Advertisement prohibited, renunciation is also prohibited. Next, this identified person can file an application with company, and the money shall be deposited in a separate bank account, and this money shall be utilized only for 2 purposes. One is adjustment against allotment. The second one is a refund of monies in case of no allotment. Sir, company received money. In that case, within 60 days of receipt of money, application money, proceed with allotment. No sir, no. In that case, within 15 days after expiry of 60 days, refund all those application monies to the applicants. Understood? Sir, delay there, sir. In case of delay, from 61st day onwards, pay interest. Company has to pay interest. So what is the interest rate? 12% per annum. In case of part one, prospectus, board of directors who are in default shall pay interest at the rate of 15% per annum. Here company will pay interest at the rate of 12% per annum, and this interest calculation starts from 61st day onwards. That means for this 15 days also, company has to pay interest. Are you all getting my point, students? Everyone? Next one. Yeah. Suppose, if this identified persons number exceeds 200, in that case, this is no more a private placement. This is deemed to be a public offer. Accordingly, private placement, part 1, prospectus and allotment of securities, part 1 shall apply. Next point, company made allotment of securities. In that case, company has to file a return of allotment in PAS 3. Return of allotment PAS 3 with ROC. Sir, what is the time limit, sir? Return of allotment, filing return of allotment. What is the time limit? 15 days. There it is 30 days. Here it is 15 days. Sir, violations are, in case of violation, fine 1000 per day, maximum 25 lakhs. Suppose private placement, the private placement contravened section 42. This private placement contravened section 42, sir. Section 42 has been contravened, sir. In that case, company promoters directors, company promoters directors will get a punishment up to 2 crores, up to 2 crores, or amount involved in private placement, whichever is lower. See, two punishments are there. One is non-filing of return of allotment, 1,000 per day to 25 lakhs, maximum 25 lakhs. Second punishment, violation of section 42. Company, every promoter, director will get a punishment. Punishment is 2 crores fine or amount involved in the private placement, whichever is lower. In addition to that, company has to refund all the application money to the applicants, and company is liable to pay interest in addition to it. So this is all about private placement. I covered all the points of private placement. Important question, so don't ignore this question. So each and every point I covered. The last topic of prospectus and allotment of securities is global depository receipts. So here I'll explain this chart. It is sufficient. The Indian company, suppose Infosys, Axis Bank wants to issue securities outside India. In that case, what Indian company can do? What an Indian company can do? Example, I will take Infosys only. Infosys. So first, it will enter into agreements with a domestic custodian bank and overseas depository bank. Right now, we are having section 23 subsection 3. According to section 23 subsection 3, prescribed class of public companies can offer its securities outside India, can list the securities outside India. But when the concept GDR is there, section 23 subsection 3 is not there. Section 23 subsection 3 is not there. This is new point, section 23 subsection 3. But before, how Indian companies mobilized foreign money? For that, answer is Indian company. It will enter into an agreement with the overseas depository. Overseas depositor. Understood? So this is depository agreement. Depository agreement. Under this agreement, Indian company will make allotment of securities or will issue securities in the name of overseas depository. And since securities, you can't issue directly outside India at that point of time. Since you can't issue directly outside India, all those securities shall be kept in the possession of domestic custodian bank. So possession of securities is held in the name of domestic custodian bank. However, these securities belongs to overseas depository. And this domestic custodian bank and overseas depository will enter into one more agreement called custodian agreement. Custodian agreement. So domestic custodian bank intimates the overseas depository bank, I'm holding these securities on behalf of you. Overseas depository bank overseas depository bank on the basis of depository agreement and custodian agreement will offer some receipts to the foreigners. And these receipts are issued by depositories, so we call them as depository receipts. And these receipts can be traded globally, so simply we can call them as global depository receipts. Now here you can observe carefully the point. These people will deposit foreign currency, suppose dollars. They deposited dollars. Overseas depository bank will credit that amount to Indian company. Overseas depository bank is the shareholder of the company, and these people are holders of GDRs. Holders of GDRs. So with respect to any general meeting, voting rights, everything, overseas depository bank will exercise on behalf of these foreign investors. So that is the concept of global depository receipt. Understood? So until these persons, whoever holding global depository receipts gets converted into shares, equity shares, until that point of time, these people will not carry any voting rights. Voting rights vested with overseas depository bank. Holder of depository receipts may become a member of company and shall be entitled to vote only on conversion of depository receipts into shares. Until the conversion of depository receipts, overseas depository shall be entitled to vote on behalf of holders of depository receipts in accordance with provisions of the agreement entered into between the depository, holders of depository receipts, and company in this regard. Understood? So with this marathon of prospectus chapter completed. Let's continue marathon with the next chapter, companies incorporated outside India. The expected weightage of this chapter in your examination is 6 marks. Difficulty point of view, simple chapter. It is very important to understand the difference between company and foreign company. So as you all know, company means company incorporated under Companies Act 2013 or previous company law. That means every domestic company, every Indian company is a company according to Companies Act 2013. Now coming to foreign company, it is a company incorporated outside India carrying business operations in India. So any company which is incorporated outside India and having a place of business in India, it is known as foreign company. Understood? So what is the main difference between company and foreign company? Company, it is incorporated under Companies Act 2013. Foreign company, it is not incorporated under Companies Act 2013. It is not incorporated under previous company law. It is incorporated outside India and carrying business operations in India. Is it clear? So what is a foreign company? Foreign company means a company or body corporate incorporated outside India and which is having a place of business in India. And that business may be carried by company itself or through an agent. Now coming to mode of business, it may be physical mode or electronic mode and conducts any business activity in India in any other manner. Clear? In interpretation of statutes, we are having one doctrine of exceptional construction. So according to doctrine of exceptional construction, here you should not consider it as and, here you should consider it as or. Understood? So any company or a body corporate which is incorporated outside India as a place of business in India or carrying business activity in India in any other manner, then such company or such body corporate is treated as foreign company. Understood? Next one. So by this it is very clear, nationality of company always depends on place of incorporation. The nationality of company doesn't depends on nationality of promoters, doesn't depends on nationality of directors, doesn't depend on the nationality of members. Nationality of company always depends on nationality of incorporation. That means place of incorporation. And every company incorporated outside India need not be a foreign company. Microsoft incorporation is there. It is not a foreign company. So company which is incorporated outside India and carrying business operations in India, then only we call it as foreign company. So by this it is very clear. Every foreign company is a company incorporated outside India. But every company which is incorporated outside India need not be foreign company. Is it clear? Everyone. The next one, deemed Indian company. It is very important. Just listen to me. One or more citizens of India or one or more companies incorporated in India or one or more body corporates incorporated in India or combination of above. That means one or more citizens of India and one or more companies incorporated in India hold at least or not less than at least 50% of paid up share capital in any company which is incorporated outside India and carrying business operations in India, then such foreign companies shall be treated as Indian companies. That means deemed Indian company. Accordingly, such deemed Indian company shall comply all the provisions of Companies Act 2013. Understood? Suppose 7 Indian citizens, 7 natural persons incorporated company in Singapore. So in Singapore, one company was incorporated and all the 100% of paid up share capital was held by 7 persons. Now this Singapore based company started one branch in India. It is carrying business operations in India. Now that Singapore based company is not treated as company incorporated outside India or it is not treated as foreign company. It is deemed to be an Indian company. Accordingly, all the provisions of Companies Act shall apply. Now if you look at this provision, deemed Indian company, not less than 50% of paid up share capital. Here paid up share capital refers to equity plus preference. So 50% of paid up share capital, whether equity or preference or partly equity and partly preference of a foreign company incorporated outside India is held by 50% of paid up share capital held by one or more citizens of India, one or more companies or body corporates incorporated in India, or one or more citizens of India and one or more companies or body corporates incorporated in India. In that case, such foreign company shall also comply with the provisions of Chapter 22 and such other provisions of this Act as may be prescribed with regard to the business carried on by it in India as if it were a company incorporated in India. That's what I told you, deemed Indian company. Are you all getting my point, students? Everyone. Actually, foreign company is required to comply Chapter 22. Chapter 22 is applicable to foreign companies. Section 380 to 386 and section 392, 393 shall apply to all foreign companies. And the section 387 to section 387 to section 391, these are special provisions applicable to body corporates which are planning to offer their securities in India. Understood? So 380 to 386 and 390 to 393, these sections are applicable to all foreign companies, whereas 387, 388, 89, 90, 91, these sections are applicable to those entities which are planning to offer securities in India. Clear? Next one. What are the documents to be delivered to registrar by foreign companies? So registration of foreign company in India. For that purpose, what are the documents to be delivered? I'll show you one flowchart. See, the documents to be delivered to ROC by foreign company. Every foreign company within 30 days of establishment of place of business in India shall file a form with ROC having jurisdiction Delhi. This form is in FC1, form number FC1. And what is the time limit for filing FC1? 30 days from the date of establishment of place of business in India. Along with this form, foreign company has to provide additional documents. So what are those attachments? What are those additional documents? First one, constitutional documents. In India, to a company, constitutional document means MOA, AOA. Understood? So if such foreign companies are also having same documents, then attach same documents, MOA, AOA, charter document, or any other instrument defining constitution of a foreign company. And these documents should be in English language. If not available in English language, then certified translated copy, yes, they need to attach in form FC1. Next one, registered office address of the foreign company. Registered office address of the foreign company. List of its directors and secretaries. List of directors, secretaries of foreign company. Next, details of authorized persons, authorized representatives who will act on behalf of foreign company in India. Suppose income tax department want to send a notice to foreign company. Now that notice will be sent to whom? Sir, that notice will be addressed to authorized representative or authorized person of foreign company. Next, place of business in India particulars. So address, principal place of business address details. Next one, previous place of business particulars. Suppose that foreign company 5 years back, it started one branch in India in Mumbai and it closed it. Now, 5 years later, they want to start a branch in Bangalore. In this case, you need to furnish Bangalore address particulars. In addition to it, Mumbai address particulars also they need to furnish. Previous place of business particulars. Next, declaration about directors and authorized representative. None of the directors have been convicted or have been debarred, not debarred from promotion management of foreign companies. So self-declaration. Next, such other information as may be prescribed. So this information is with respect to foreign company. Now, in addition to this information, we need to provide information related to directors, secretary. So what is that information, sir? Name, surname of the director as well as secretary. Father name, mother name, spouse name, date of birth, residential address, nationality of the directors, PAN, passport number. Next, occupation of the directors as well as secretary. Next, directorship in other companies. Email ID. Next, in case of company secretary, yes, secretary has to furnish membership number, institute membership number. So all this data, all this information, yes, foreign company has to file with ROC having jurisdiction Delhi. What is the applicable form? FC1. What is the time limit? 30 days from date of establishment of place of business in India. Is it clear, everyone? Now, any changes in these particulars, suppose change in address, change in directors, change in details of the directors, understood? Any changes, yes, foreign company has to intimate all the changes with ROC, and the applicable form is FC2. Applicable time limit is within 30 days of alteration. Within 30 days of changes, foreign company has to intimate ROC having jurisdiction Delhi. Here this form is FC2. Original FC1. Alteration, for filing alterations, FC2. Is it clear, everyone? So with this, section 380 completed. Section 380 completed. You can see, according to section 380 subsection 1 of Companies Act, every foreign company shall, within 30 days of establishment of place of business in India, deliver documents to registrar, that is ROC, for registration. What are those documents? Certified copy of charter, full address of the registered office, list of directors and secretary of the company, containing such particulars. Which particulars? Personal name, surname, former name, previous name. Suppose name of the director has been changed. In that case, what is your former name and what is your present name? Next, father name, mother name, spouse name, date of birth, residential address, nationality. Present nationality is not the nationality of origin, then nationality of origin. Suppose, he's a Singapore citizen. Now he went to USA. He became USA citizen. In that case, you need to furnish the details of both countries. Understood? Passport number, income tax PAN, occupation, whether directorship in any other Indian company, furnish those details. Other directorship or directorships held by him in other countries, in other companies. Next, membership number in case of secretary, and email ID. An important point, declaration that none of the directors of the company or the authorized representative in India has ever been convicted or debarred from formation of companies management either in India or outside India. So this declaration, who should furnish this declaration? Directors of the company as well as authorized representative in India. So secretary, company secretary is not required to file this declaration. Very recently in MTP, MCQ was tested for 2 marks. So who should file this declaration? Options, director, secretary, authorized representative. Like that, options were given. So we need to select 2 correct options. 2 correct options are directors, authorized representatives in India. Understood? Next one, form I told you, form FC1. Next, with which ROC? ROC having jurisdiction over New Delhi. So that's it. And what is the time limit for filing these forms? Within 30 days. Starting point, I discussed with you. Within 30 days of establishment of place of business in India, yes, every foreign company shall deliver documents to registrar for registration. Now, in case of alteration of documents shall be intimated to registrar. What is the applicable form? FC2. And what is the applicable time limit? 30 days of such alteration. Everyone, is it clear? Okay. Next, the section 381, accounts of foreign company. Accounts of foreign company. See, every foreign company shall prepare financial statements in the same form, similar to Schedule 3 only, Schedule 3 format only, with respect to Indian business operations. What are all the operations carried out in India with respect to those operations? So what is the turnover? What is the total cost of production? What is the gross profit? What is the net profit? And what is the financial position of the entity with respect to Indian business operations? Yes, foreign company has to prepare financial statements in form Schedule 3. Along with that, along with the financial statements, yes, foreign company has to prepare a board report as well as annexures. But these financial statements, board report and annexures should speak about operations that were carried in India, not across the world. Understood? Suppose, Kia Motors company, South Korean company is there. It is operating in 10 countries. Imagine. One among the 10 countries is India. Now, in India, what are all the operations were carried out? And what is the financial result of those operations? What is the position of those operations? Yes, furnish that information in Schedule 3. Furnish that information in board report as well as annexures. Along with that, foreign company is required to file a latest consolidated financial statements of parent foreign company. Understood? So Kia, South Korean company, right? So South Korean company has to prepare consolidated financial statements, and one copy of such consolidated financial statement shall be filed with registrar. Next one, details of place of business established by foreign company in India. Next one, statements of related party transactions, statement of repatriation of profits, taking back the profits to the origin, Next, the statement of transfer of funds from parent company to branch office in India. Understood? So all these information you need to prepare, and you need to file it with ROC in every calendar year. And what is the applicable form? Applicable form is FC3. And what is the applicable time limit? Within 6 months from the closure of financial year. And here the definition of financial year is similar to the definition of financial year in accounts of companies. That is, every company incorporated on or after 1st January, then financial year closure date shall be 31st March of following year. Understood? First financial year closure date shall be 31st March of following year, when if company is incorporated on or after 1st January. In all other cases, financial year closure date will be 31st March. Understood? Everyone. Of course, if few entities wants to follow different financial year, then they can file an application with central government. They can request central government, because of these reasons we want to follow different period as financial year. If central government approves the application, then they can follow different period as a financial year. Understood, everyone? So every foreign company has to file these documents with ROC. What is the applicable form? FC3. And what is the time limit? 6 months from closure of financial year. In case if you want extension, yes, extension will be granted subject to maximum 3 months with ROC approval. Maximum how many months? 3 months with ROC approval. So that is all about section 381, accounts of foreign company. Clear? The note point, just now I explained you definition of financial year only. And these 1 and 2 points already summarized, and I gave it in chart. Next one, audit of accounts of foreign company. Every foreign company shall get its accounts pertaining to Indian business operations prepared in accordance with section 381 subsection 1 and rules made thereunder shall be audited by a practicing chartered accountant in India, or a firm or LLP of practicing chartered accountants. The lawmaker is not asking foreign company to get its accounts audited, not complete accounts. Only the accounts pertaining to Indian business operations shall be audited. And who can conduct audit of foreign companies? Practicing chartered accountant, or firm of practicing chartered accountants, or limited liability partnership of practicing chartered accountants. In that case, provisions of chapter 10, that is audit and auditors, rules made thereunder as far as applicable shall apply to the foreign company. So that is all about section 381. Section 381, accounts of foreign companies, audit of foreign companies. Next is section 382, display of name of foreign company. Display of name of foreign company. Every foreign company shall display the name of company, country of incorporation, and in case members liability is limited, then disclose the limited liability of the members. If members liability is limited, then disclose the liability. So what is the nature of liability? Sir, liability is limited. Limited to what extent? Limited to the extent of guarantee, or limited to the extent of unpaid value. So disclose these points. So every foreign company shall display the name of company, country of incorporation, as well as nature of members liability on name board as well as official publications. Now coming to the name board. So wherever it is carrying business operations, outside that office, the name board shall contain these particulars: name, country of incorporation, nature of members liability. And these things shall be displayed in English language as well as regional language. Suppose foreign company started operations in Bangalore. So what is the regional language in Bangalore? Kannada. So English plus Kannada. Suppose it started business operations in Chennai, then English plus Tamil. Understood? Next one, official publications means letterheads, bill copies, invoices, like that. So in case of official publications, English language is sufficient. No need to add regional language. So that is all about section 382 ma. That is all about section 382. So I gave you summary. Is it clear? In English language as well as one of the languages in general use in the locality in which office or place is situated. Coming to the official publications, English language is sufficient. Legible English characters. Clear? Everyone, just pause the video and copy this content, ma. Just pause the video and copy this content. Next one, section 383. Discuss the provisions of Companies Act regarding communications with foreign company. So service of documents on foreign company. Service of documents on foreign company. Any process here refers to legal process. Issue of notices, issue of court orders, issuing summons, like that. Any process, notice or other document required to be served on a foreign company shall be deemed to be sufficiently served if addressed to any person whose name and address have been delivered to registrar under section 380 and left at or sent by post to the address which has been so delivered to the registrar or by electronic mode. So service of documents to foreign company is said to be valid when service of document to foreign company is valid when if it is addressed to authorized representative address. Authorized representative, any person whose name and address have been delivered to registrar under section 380. That means authorized representative in India. If a letter is posted to authorized representative address and if it is posted to the address which has been so delivered to registrar by electronic mode, principal place of business in India, the address which has been delivered to registrar, particulars of address which has been delivered to the registrar. To that address, if we send a notice, that's it. It is said to be valid service of notice. Valid service of notice. If a letter is addressed to authorized representative and if a letter is addressed to the address which has been so delivered to registrar. Next one, electronic mode. That service of notice is said to be valid. Next, discuss the provisions of Companies Act 2013 regarding inspection of books, annual returns of foreign company. Section 384. Simple chart, ma. Section 384. Simple chart. Issue of debentures by foreign company. It has to comply the provisions of section 71. For the purpose of issue of debentures, foreign company here treated as Indian company. Indian company has to comply section 71 for issue of debentures, right? Similarly, foreign company shall also comply the provisions of 71 for issuing debentures. Next one, filing of annual returns. Section 92 is applicable to Indian company. Similarly, foreign company has to file annual returns, same like Indian company. But the form is FC4. Applicable form is FC4. And what is the time limit for filing FC4, sir? 60 days of last date of financial year. Within 60 days of last date of financial year, foreign company has to file annual returns with registrar having jurisdiction over Delhi. So time limit is different, form is also different. Yes or no? MGT 7 in case of Indian companies, FC4 in case of foreign companies. Next one, 60 days from the conclusion of AGM is the time limit for Indian companies. Coming to foreign companies, the time limit is 60 days of last date of financial year, closure date of financial year. Understood, everyone? Next, CSR provisions. Section 135, which is applicable to Indian company, is similarly applicable to foreign company. So with respect to Indian business operations, if net worth is exceeding the limit, if turnover is crossing the limit, net profit is crossing the limit, then such foreign companies shall comply the provisions of section 135. Understood? Net worth 500 crores or more, turnover 1000 crores or more, net profit 5 crores or more. So any foreign company with respect to Indian business operations satisfying any of these three conditions has to comply the provisions of section 135, that is corporate social responsibility. Next, section 128, books of accounts, foreign company, Indian company, both have to follow section 128. Next, registration of charges. chapter 6, which is applicable to Indian company, is equally applicable to foreign company. Next one, chapter 14, inspection, inquiry, investigation. Here also foreign company has to comply these chapter provisions similar to Indian company. Similar to Indian company. So that's what given here itself. Debentures, annual returns, books of accounts. Books of accounts. Indian companies, books of accounts means incomes, expenditures, receipts, payments. Incomes, expenditure, sales and purchase only. Sales and purchases, receipts and payments, assets and liabilities, items related to cost. Items, cost records. Coming to the foreign company, same point. Receipts, payments, sales, purchase, assets and liabilities. But here, books of accounts is restricted to the operations that were carried in India. Next, charges. They need to comply chapter 6. Inspection, inquiry and investigation. Chapter 14 is applicable. Understood. And fees for registration of documents. Yes, in all these sections I told you, every time foreign company has to file documents with registrar. Such filing of those documents shall be accompanied with a prescribed fees. Is it clear, everyone? So charges, yes, I told chapter 6 only, correct. Chapter 6, registration of charges is equally applicable to foreign company like Indian company. Next one, special provisions. So up to here, general provisions applicable to all foreign companies. Now, from here onwards, section 387 onwards, these are special provisions. These provisions are applicable to foreign companies which is planning to offer its securities in India. Suppose a foreign company is not planning to issue securities in India. In that case, section 387 is not applicable. Section 387 is not applicable. Understood? So 387 to 391, these sections I call them as special provisions. Clear? Okay, fine. So provisions of Companies Act regarding issue of prospectus by foreign company. Issue of prospectus by foreign company. So every prospectus shall be dated and signed. So prospectus, before issuing prospectus, that prospectus shall be dated and signed. So signed by whom? Signed by the persons authorizing the issue of prospectus. And shall also contain the particulars, following matters, namely instrument constituting or defining the constitution of the company, MOA, AOA, constitutional documents. Next one, enactments or provisions by or under which incorporation of the company was effected. Which foreign company law, according to which foreign company law the company came into existence, furnish those details. Principal place of business address in India. Next one, date on which and the country in which company would be or was incorporated. Yes, on behalf of future companies also, a person can offer securities on behalf of future companies also here. If you read section 387, it starts with no person. So need not be a company, need not be a body corporate. Understood? So on behalf of future body corporates, future foreign companies, yes, a person can offer this kind of securities. Is it clear? So no person shall issue, circulate, distribute in India any prospectus offering to subscribe for securities of a company incorporated or to be incorporated. One is already incorporated. The other one is to be incorporated outside India, whether the company has or has not established or when formed will or will not establish a place of business in India. So this section is talking about all the body corporates. This section is not restricted to a foreign company. I told you the difference between body corporate and foreign company. Now body corporate includes company incorporated outside India. Whereas foreign company, it is a company incorporated outside India and carrying business operations in India. Beginning of this lecture, I told you, foreign company is different and a company incorporated outside India is different. Every foreign company is a company incorporated outside India, but every company incorporated outside India need not be a foreign company. Yes or no? Everyone. Okay, so in addition to the prospectus, yes, these are the documents we need to attach. We need to file with registrar for registration of prospectus. Whether company has established a place of business in India, and if so, the address of its principal office in India. Next one, 1, 2, 3. 5 points are there. Out of 5 points, 1, 2, 3. These 3 points are not applicable to companies, are not applicable to the companies, are not applicable in case prospectus issued more than 2 years after the date at which company is entitled to commence business. That means, company already incorporated, company already commenced business operations and 2 years completed. So company with age of 2 years or more is not required to furnish first 3 documents. It's enough if they furnish 4 and 5 documents. Understood? So new companies, recently incorporated body corporates have to furnish all these 5 documents. A company which has completed 2 years from the date of commencement of business, entitled to commence the business, they are not required to furnish first 3 particulars. It's sufficient if they furnish 4 and 5 particulars. Clear, everyone? Next one, no waiver of complaints in prospectus. This is similar to section 40. I discussed with you in prospectus chapter. In previous marathon itself. In prospectus, I told you, any waiver of complaints, such conditions stand void. Agreement in restraint of trade, agreement in restraint of marriage. Did you remember such agreements? Yeah, you studied in your CA foundation. Agreement in restraint of trade, agreement in restraint of marriage. To that extent, those agreements stands void. Yes or no? Now, waiver of complaints, any condition if you find in this prospectus, to that extent, those conditions stand void. Next one, form of application for securities to be issued along with prospectus. In prospectus chapter, this concept is similar to abridged prospectus. Every application form shall be accompanied with abridged prospectus. And a person who requests for complete prospectus, yes, it is the duty of company to furnish complete prospectus to the requested person. I told you. Now here also, yes, every application form shall satisfy the conditions specified in section 387 subsection 1. The form should be issued with a prospectus which complies with the provisions of this chapter 22, and such issue does not contravene the provisions of section 388. Exception, that means, these rules are not applicable in the following cases. Sir, what is that case, sir? In case of entering into an underwriting agreement, no need to comply this condition. Similar concept I already explained with you in abridged prospectus concept. This is similar to abridged prospectus. Abridged prospectus is something by Indian companies, and this concept is something by foreign companies. Clear? Next one. The provisions of section 387 shall not apply to the issue of prospectus or form of application relating to the securities of the company to the existing members, existing debenture holders of the company. This section 387, issue of prospectus, dating of prospectus, signing of prospectus is not applicable in case securities are offered to the existing members, in case securities are offered to the existing debenture holders. Same point, ma. Next one, in case securities are uniform in all respects with the securities previously issued, and such previously issued securities are already listed on recognized stock exchange, then also section 387 shall not apply. So section 387 prospectus is not applicable in 2 cases. One is offer made to the existing members, existing debenture holders. Second one, offer related to offer of issue of securities which are uniform in all respects with the securities previously issued, and those previously issued securities are already listed on recognized stock exchange. Understood? So yes, for this also I prepared a chart. Yeah, you can see this. Every prospectus shall be dated and signed, shall contain prescribed matters. The instrument defining constitution of foreign company, enactments or provisions under which foreign company was incorporated, address for inspection of constitutional documents, principal place of business particulars in India, date of incorporation and country of incorporation of the foreign company. In case company which has completed 2 years of time period from the date it is entitled to commence business operations, such companies are not required to furnish first 3 particulars. They are not required to furnish first 3 particulars. Next one, waiver of complaints is not allowed. Next, every application form shall be accompanied with a copy of prospectus, and this is not applicable in case of invitation sent to the underwriters for entering into the underwriting agreement. And these provisions are not applicable when an offer is made to the existing members, existing debenture holders, or offer is made for securities which are uniform in all respects with previously issued securities, and such previously issued securities already dealt on recognized stock exchanges. Clear? So I just pause the video and take this screenshot or note it down. Next one, expert consent. So to include expert consent, what are the conditions a foreign company should satisfy? First one, foreign companies should obtain written consent to include expert statement in the prospectus, and that expert has not withdrawn such consent before delivery of a copy of prospectus to the registrar for registration, and a statement to that effect shall be included in the prospectus. So this is almost similar to section 26 of Companies Act 2013 only. But in section 26, you will find one more additional condition. That additional condition is expert is not connected with formation, management, promotion of the companies. That means expert should not be promoter of the company. That is the extra condition you can study in section 26 of Companies Act 2013. Next one, registration of prospectus, section 389. No person shall issue, circulate or distribute in India any prospectus offering for subscription in securities of a company incorporated or to be incorporated. This matter is common. Up to here, this matter is common. In each and every section, you can see first 3 lines common only. Unless before that issue, circulation, distribution in India, it has to satisfy the following conditions. What are those conditions? A copy thereof certified by the chairperson of the company and 2 other directors of the company as having been approved by resolution of managing body has been delivered for registration to the registrar. That means signed prospectus shall be delivered to ROC for registration. Sir, who can sign this prospectus? Chairperson of the company and 2 other directors who have been approved by the board resolution, who have been approved by the board by passing a resolution. Understood? Next, prospectus states on the face of it the copy has been so delivered. This is the disclosure point. Disclose that a copy of prospectus has been delivered to ROC, and there is endorsed on or attached to the copy any consent to issue of prospectus required by section 388 and such documents as may be prescribed. Suppose expert made one statement on the prospectus. Now you want to include expert statement, and you included expert statement in the prospectus. Now mention that point. So and so expert made one statement, and that statement is attached to the prospectus. Like that, make a disclosure. So what are all the documents attached to the prospectus? Make a disclosure. Next, any consent to the issue of prospectus required from any expert as an expert. Next, a copy of contracts for appointment of managing director, manager, and in case of contract not reduced into writing, then a memorandum giving full particulars thereof. So these documents. Next one, copy of material contracts, copy of underwriting agreement, copy of power of attorney if prospectus is signed by through duly authorized agent of directors. So you need to attach all these 5 documents to the prospectus. One is expert consent. Next one is contracts for appointing managing director, manager. Next one, material contracts not entered in the ordinary course of business but entered within preceding 2 years. So what are all the material contracts entered into in the preceding 2 years? Furnish those details. Copy of underwriting agreement and copy of power of attorney. When this copy of power of attorney is required? When the prospectus is not signed by the directors but it is signed by the agent of directors. In that case, power of attorney, directors delegating power to agent. So that copy of power of attorney you need to attach to the prospectus. Understood? Next one, issue of Indian depositories by foreign company. So very simple, Indian depository receipts. In case of global depository receipts, what actually happens is Indian company will enter into an agreement with overseas depository. Based on this agreement, it will deposit securities with the domestic custodian bank in India, located in India. Now this domestic custodian bank and overseas depository will enter into one more agreement, that is custodian agreement. And the agreement between Indian company and overseas depository is depository agreement. So based on these agreements, overseas depository will create receipts and will issue these receipts to the foreign investors. So foreign investors will deposit foreign currency with overseas depository, and overseas depository will transfer the funds to Indian company. So this is the concept of global depository receipts. Now coming to Indian depository receipts, quite opposite. So here you will see company incorporated outside India will enter into an agreement with a domestic depository in India, and that agreement is depository agreement. So based on this agreement, company incorporated outside India will deposit its securities with overseas custodian bank that is outside India. Now this overseas custodian bank as well as domestic depository will enter into one agreement called custodian agreement. Now based on these agreements, domestic depository, for example NSE, will create receipts and will issue receipts to Indian investors. And these are the receipts issued by depository, so we call them as depository receipts. And these depository receipts are getting traded in India. It is known as Indian depository receipts. Understood? So this concept is similar to global depository receipts. In global depository receipts, you will find Indian company. In Indian depository receipts, you will find company which is incorporated outside India. Next one, applicability of chapter 15, that is compromises, arrangements and amalgamations. Compromises, arrangements, amalgamations. Now this chapter generally applicable to Indian companies. Chapter 15, compromise, arrangement, amalgamation, is applicable to Indian companies. For the time being, this chapter is also applicable to foreign companies. Compromise, foreign company which carried business operations in India. The position in India is not good. It is an insolvent position. The assets located in India are not sufficient to meet the liabilities in India. So they need one arrangement, they need compromise. So they need to settle those debts, or they want to, the operations which were carried in India, foreign company carrying business operations in India, to that extent they want to merge with an Indian company. Understood? Or they want to acquire Indian company. So all this comes under compromises, arrangements and amalgamations. So this is possible only with the prior approval of Reserve Bank of India. With the prior approval of Reserve Bank of India, yes, a foreign company can get merged into Indian company, or a foreign company may acquire Indian company. So merge into a company registered under this act, that means Indian company, or vice versa, Indian company getting merged into foreign company. Understood? So chapter 15 is applicable to foreign companies too. Next one, punishments, just give one time reading ma. Punishments, just give one time reading. Yes, section 392 is very 392 and 393. So chances of getting one question is very high. 392, 393. 392. A foreign company shall be punishable with fine which shall not be less than 1 lakh rupees but which may extend to 3 lakh rupees, and in case of continuing offense with an additional fine which may extend to 50,000 rupees for every day after the first during which contravention continues. So if any contravention with respect to provisions of chapter 22, then this general punishment is applicable. Are you all getting my point, students? So section 382, 386, any violation in these sections, improper filings with registrar, or no filings with registrar, not maintaining books of accounts properly, not preparing financial statements properly, not getting audited. In that case, this is the general punishment. What is the general punishment? 1 lakh rupees minimum, maximum 3 lakh rupees. In case of continuing offense, additional fine of 50,000 rupees per day during such default continues. This is applicable to foreign company. Then officer, authorized representative will also get punishment. The punishment is 25,000 rupees to 5 lakh rupees. Next one, company failure to comply the provisions of this chapter not to affect validity of contracts, etc. Suppose company violated section 382, section 386. Understood? So violation of this chapter, what would be the effect on the contracts entered by foreign company? Suppose within 30 days it has to file documents with registrar, right? Within 30 days of establishment of place of business in India, it has to file documents with registrar. Violated that provision. Meanwhile, it entered into contracts with everyone. Now, all those contracts valid or void? The answer is valid. The answer is valid. It shall not affect the validity of any contract, any dealing, any transaction entered into by the company or its liability to be showed in respect thereof. However, company shall not be entitled to bring any suit, any set of or any counterclaim or institute any legal proceedings in respect of any such contract, dealing or transaction until it has complied with the provisions of Companies Act 2013 applicable to it. Generally, companies can sue, companies can be sued, yes or no? Suppose company can sue debtor, creditor can sue company. Company is not getting money from debtor, company can sue debtor. If company is not paying money to creditor, then creditor can sue company. That means company can be sued. Now a foreign company which is not complying the provisions of Companies Act 2013 which are applicable to them, in that case such foreign company can be sued. Outsiders can sue foreign company, but foreign company can't sue outsiders. Foreign company can't sue outsiders. Sir, lifelong, sir? No. If such foreign company starts complying the provisions of Companies Act 2013, then they can sue outsiders. Are you all getting my point, students? Everyone. So what is the difference, ma? Foreign company can be sued, whereas foreign company can't sue outsiders. Until when? Until company has complied the provisions of Companies Act 2013 applicable to it. So that's it with this foreign company completed. Our next chapter for marathon is Audit and Auditors. The expected weightage of this chapter in your examination is 6 marks. Lengthy chapter, difficulty point of view, moderate chapter. Clear? As you all know, the most significant characteristic of company is separate legal entity. Company is separated from its owners. Company is separated from its members. So what is the role of members in the company? They contribute money whenever company need funds. And company will carry business operations with the funds contributed by members. And you all know, company is an artificial person. Being an artificial person, it can't carry its activities on its own. So that's why company appoints directors. Company will have management. Management will manage business operations of the company. Now at the end of the year, management will prepare financial statements of the company. Who is preparing financial statements? Management. Who is doing business operations? Management. Understood? So there arises a doubt whether financial statements are free from material misstatements or not. Whether financial statements are prepared in accordance with applicable financial reporting framework or not. Now to eliminate these doubts, to enhance confidence over the financial statements among the users of the financial statements, among the readers of the financial statements, lawmaker made audit compulsory. Now every company shall appoint auditor. Sir, who can be appointed as an auditor, sir? So two persons. One is individual practicing chartered accountant and the second one is a partnership firm, including limited liability partnership. If company wants to appoint firm as auditor, then that firm should satisfy two conditions. One is majority of partners should be practicing chartered accountants, and majority of practicing chartered accountants who are the partners of the firm. Majority of the partners should be practicing chartered accountants and majority of the partners should practice in India. So let's have an example. There is a firm called XYZ and Co. In this partnership firm, there are three partners, X, Y, Z. X is a practicing chartered accountant, Y practicing chartered accountant, Z practicing cost accountant. X, Y, Z, both two partners are practicing in India, and Z in USA. Now is XYZ and Co. eligible to act as an auditor of the company? Yes. Just look into the conditions. Majority of the partners. Majority means how much? More than half. More than half. Yes, here two partners are practicing chartered accountants and they are practicing in India. Understood? Everyone. So individual practicing chartered accountant or firm. In case of firm, majority of partners shall be practicing chartered accountants and practicing in India. Is it clear? Next one, appointment of auditor. Here auditor, two categories. First auditor, subsequent auditor. Sir, who can be called first auditor? Upon incorporation, the auditor who was appointed by the company is known as first auditor. Are you getting my point, students? First auditor is nothing but auditor who was appointed by the company upon incorporation. Now, any auditor subsequent to first auditor is subsequent auditor. Understood? Appointing authority. Sir, who can appoint first auditor? So here companies are categorized into two categories: government company, non-government company. In case of government company, appointing authority is C&AG. C&AG within 60 days of incorporation, C&AG shall appoint auditor to the government company. If C&AG fails to appoint within 60 days of incorporation, then board of directors shall appoint auditor within next 30 days. If board of directors fails to appoint auditor within next 30 days, then members shall appoint a first auditor within the next 60 days. So appointing authority in case of government company, first auditor, C&AG, board of directors, members. Clear? And the tenure of first auditor in case of government company is till the conclusion of first annual general meeting. Now coming to non-government company, board of directors within 30 days of incorporation of company shall appoint first auditor. If board of directors fails to appoint first auditor, then members shall appoint a first auditor within 90 days. So appointing authority is board of directors, members in case of non-government company. Now coming to the tenure of first auditor in case of non-government company is till the conclusion of first AGM. Till the conclusion of first AGM. Next one, subsequent auditor. In case of government company, the appointing authority is C&AG. No other option, C&AG. C&AG shall appoint a subsequent auditor within 180 days of commencement of financial year. And the auditor so appointed by C&AG in a government company shall hold the office till the conclusion of annual general meeting. Understood? Next, in case of non-government company, appointing authority is members. Members in annual general meeting by passing ordinary resolution shall appoint auditor, and the appointed auditor shall continue to hold his office till the conclusion of a 6th annual general meeting. So in case of non-government company, a subsequent auditor can be appointed for a term of 5 years. Are you all getting my point, students? Everyone. And the next topic is rotation of auditors. See, rotation of auditor is not applicable to all companies. It is applicable to prescribed companies. Sir, what are those companies? Just observe carefully. Listed companies, unlisted public companies with paid up share capital 10 crores or borrowings or deposits 50 crores or more. In case of unlisted public companies, what are the limits? Paid up share capital 10 crores or more, or borrowings deposits 50 crores or more. Coming to private companies, paid up share capital 50 crores or more, or aggregate borrowings deposits 50 crores or more. Now to these companies, rotation of auditor concept is applicable. If rotation of auditor concept is applicable, then an individual can be appointed for a term of 5 years, maximum 1 term of 5 years. In case of firm, including LLP, audit firm can be appointed as an auditor for 2 terms of 5 consecutive years. Once tenure is completed, then that said firm is not eligible for reappointment. So there is a cooling period of 5 years. Till the completion of 5 years, yes, the said individual or said firm is disqualified for reappointment as an auditor to the company. Understood? Everyone. After cooling period, yes, company can appoint same individual, same partnership firm as auditors. So what is the maximum tenure ma? In case of individual, 1 term of 5 consecutive years. In case of firm or LLP, 2 terms of 5 years. And next one, tenure completed. Now the existing auditor is treated as former auditor or outgoing auditor or retiring auditor. And company has to appoint another audit firm as an auditor, which we call it as incoming auditor. Now take these two forms, retiring auditor, incoming auditor. A retiring auditor, incoming auditor should not have any common things like common partner, like these two firms working under common network, common brand, or these two firms are owned by one person. In all these cases, incoming auditor is also said to be disqualified. Is it clear? Suppose XYZ and Co is the auditor to company C Limited. Tenure completed. Now C Limited wants to appoint Z, A, B and Co as auditors. Now if you observe carefully, Z is a common partner in these two firms. So not only XYZ and Co, but also Z, A, B and Co also gets disqualified. Are you all getting my point, students? And retiring auditor, incoming auditor, they should not operate under common network, common brand or common ownership. So this is all about rotation of auditors. Rotation of auditors, applicability limits are very, very important. So coming to the applicability, it is applicable to listed companies without any limits. It is applicable to unlisted public companies which is having paid up share capital 10 crores or more, or borrowings or deposits 50 crores or more. Private companies, paid up share capital 50 crores or more, borrowings, deposits 50 crores or more. Understood? Next one, procedure for appointment of auditor. Procedure for appointment of auditor. Here companies classified into three categories: listed companies, unlisted public companies with paid up share capital 10 crores or more, or turnover 100 crores or more, or borrowings, deposits 50 crores or more. Remember the limits, ma. See, public company fulfilling all the three limits, wrong. Public company fulfilling any of these three limits, correct. Any public company satisfying any of these three conditions shall constitute audit committee. So what are those three limits? Paid up share capital 10 crores or more, borrowings, debentures, deposits 50 crores or more, turnover 100 crores or more. Then such public companies as well as listed companies shall have audit committee. And in audit committee, you will find directors. Majority of the directors shall be independent directors. So independent director is a director who will not have any interest in the company, who will not have any relationship with company. Is independent. Understood? So majority of directors of the audit committee shall be independent directors. Now this audit committee will make a recommendation to the board of directors regarding a proposal, regarding proposed auditor. So board of directors are having two options, either to consider the recommendation or return back the recommendation. If board of directors selects recommendation, then board of directors will make further recommendation to members in annual general meeting. Members in annual general meeting, by passing ordinary resolution, appoints auditor of the company. Suppose board of directors decides to refer back recommendation to the audit committee, then they will refer back the recommendation along with the reasons. So these are the reasons why we are not considering the recommendation. Now audit committee, once again they will make a recommendation. So they may go with the original recommendation or they may modify the recommendation. And this cycle continues. So if board agrees with audit committee, board will recommend to members. Suppose the second time audit committee made a recommendation which board of directors didn't like that recommendation. They are not okay with the recommendation. Now board of directors will make a fresh recommendation to members. Along with the fresh recommendation, board of directors has to pass an information why we didn't consider audit committee recommendation. So ultimate authority lies with members. So members will take a decision. Members will make a decision by passing ordinary resolution. In case of other companies, companies not falling in these two categories, so no need to have audit committee. If audit committee is not there, then board of directors will make a recommendation to members. Members in annual general meeting, by passing ordinary resolution, appoints auditor of the company. But before appointment, on behalf of company, either audit committee, if audit committee is applicable, or board of directors, if audit committee is not applicable, shall make a proposal to the auditor. Now it is the duty of auditor to give consent, whether to act as an auditor, whether to be appointed as an auditor or not to be appointed as an auditor. So auditor must give consent. Along with the consent, he should give a certificate. So certificate should contain two particulars. One is he is not disqualified to accept the audit engagement, and the proposed audit engagement is within the limits prescribed. So maximum an auditor can audit 20 companies. Understood? So in a financial year, he can be appointed as an auditor for 20 companies. So that is what ceiling limit. I'll discuss with you under disqualification category. Just wait. So auditor has to give consent as well as certificate. If auditor selects, yes, if auditor is okay with the audit engagement, then he has to give consent as well as certificate. Once company appoints him as an auditor, then within 15 days, company has to communicate the same with ROC, form ADT1. And what is the time limit? 15 days from appointment. So this limit is common in case of government company as well as non-government company. In case of first auditor as well as subsequent auditor. Clear? Next one. At the time of appointment as well as after appointment, auditor shall not possess these disqualifications. When? At the time of appointment, he shall not possess these disqualifications. Even after appointment, during audit tenure, during audit office, he shall not possess these disqualifications. Sir, suppose at the time of appointment, I am not having any disqualification, sir. I am not possessing any disqualification. But after appointment, 2 months after appointment, I was disqualified. Then what is the solution? What is the consequence? Yes, automatically you will come out from the audit office. So there arises vacancy in the audit office. Board of directors shall appoint a auditor to fill the casual vacancy in case of non-government companies. Understood? Seema, disqualifications. Sir, what are those disqualifications? All body corporates except LLP are disqualified to act as an auditor of the company. Suppose me, my friend Prashant, we both incorporated one company, SV Consultancy Services Private Limited. Understood? Now that company is disqualified to act as an auditor of other companies. Suppose I am also an individual practicing chartered accountant, I am also director of that company. Now can I appoint as an auditor? Can I be appointed as an auditor in any other companies? Yes. Are you all getting my point, students? See, I am an individual practicing chartered accountant, I am also director in one company. Now I can be appointed as an auditor of other companies. There is no bar on it. Of course, I cannot audit my company. Where I am working as a director, I am not eligible to act as an auditor. Why? Officer of the company, employee of the company, partner of officer, employee of officer, partner of employee, employee of employee. All these 6 persons are disqualified. Understood? Officer of company, employee of company, partner of officer of company, employee of officer of company, partner of employee of company, employee of the company. All these 6 persons are disqualified. Next disqualification, person, relative, partner. Person's relative, person, partner. Holding security in company, associate company, subsidiary company, holding company, subsidiary of holding company. Disqualified. But there is one exception. A relative can hold up to 1 lakh face value of securities. Face value is very, very important. In examination, to confuse you, they will give market value. Suppose so and so person who is the relative of auditor is holding 90,000 face value of securities, and currently they are trading at 1,20,000 rupees in stock markets. So qualified or disqualified? Just look at face value. Face value less than or equal to 1 lakh, no disqualification. Face value exceeding 1 lakh, disqualification. Understood? Everyone. Next, person or relative or partner indebted to these any of these 5 companies. Company, associate company, subsidiary company, holding company, subsidiary of holding company. In excess of 5 lakh rupee, again disqualified. No exception. Up to 5 lakhs, no disqualification. Exceeding 5 lakhs. Sir, exactly 5 lakhs, sir. I am indebted to the company exactly 5 lakhs. Qualified or disqualified? Not disqualified. Exceeding 5 lakh rupee, disqualified. Next one, person or whose relative or partner gave a guarantee to any of these entities on behalf of third party. In excess of 1 lakh rupee. Again disqualification. This is direct indebtedness. This is indirect indebtedness. Understood? Guarantee indirect indebtedness. Next disqualification, person having business relationship with these 6 entities: company, associate company, subsidiary company, holding company, subsidiary of holding company, subsidiary of associate company. So any person having business relationship with the company, then that person is disqualified. Of course, 2 exceptions are there. If the business transactions between these 2 persons are happening in ordinary course of business, and the person is providing ICI permitted services to these entities, then no disqualification. Next one, person's relative is a director or KMP of the company. Person's relative who is a director or KMP of the company, then also that person is disqualified. Understood? Next one, a person who is in full-time employment elsewhere. If he is full-time employee, when he will find time to conduct audit of the financial statements of company? So full-time employee, disqualified. See, there is a difference between employee in this category and full-time employment elsewhere in this category. So what is the difference? Employee of the company, see, C Limited is a company and I am employee in C Limited. So this falls in the second category. This falls in the second category. Employee of C Limited is disqualified to act as an auditor of C Limited. Suppose F is there. F is employee of E Limited. Okay, wait. A Limited. F is employee of A Limited. Full-time employee. Now, can F be appointed as an auditor of C Limited, sir? F is not employee of C Limited, sir. F is employee of A Limited, sir. Now, can F act as an auditor of C Limited? No. Why? He is in full-time employment elsewhere. First of all, if you are a full-time employee, you are not eligible to get a certificate of practice. So without certificate of practice, you are not considered as practicing chartered accountant. If you are not a practicing chartered accountant, then you are not qualified to act as an auditor of the company. Understood? Next one, maximum he can accept 20 audit company engagements. While counting 20, following 4 companies are excluded: 1-person company, small company, dormant company, and private limited companies with paid up share capital less than 100 crores. Private limited company with paid up share capital less than 100 crores. These 4 entities can be excluded. Other than these 4 entities, count how many companies, in how many companies is the auditor. If it is exactly 20, then he is disqualified to accept 21st company audit engagement. Understood? 21st audit company engagement, he is disqualified. Suppose if he want to accept 21st company audit engagement, then he need to resign any one out of these 20 companies. Next disqualification, person convicted by offense involving fraud and 10 years not lapsed. So till the completion of 10 years from the date of conviction, he is disqualified. Very important point is offense involving fraud. Offense involving fraud. Suppose he was convicted by an offense which was not involving any fraud. So their fraud is not there. In that case, this disqualification will not attract. Understood? Suppose a person met with an accident. A person made an accident and the opposite person died. Because of that, he was sent to jail for 5 years. Now here he committed an offense, but there is no concept of fraud in this offense. So this disqualification will not attract. Next one, rendering section 144 services. A person rendering section 144 services, again he is disqualified. He cannot be appointed as an auditor of the company. Sir, what are the services covered in section 144? Design and implementation of information system, accounting and bookkeeping, management services, investment advisory services, investment banking services, actuarial services, internal audit. A person cannot do both internal audit as well as external audit. If you are appointed as an external auditor, you can't do internal audit. If you are appointed as an internal auditor, then you cannot act as an external auditor. Next, outsourced financial services and such other services as may be prescribed. So if you are rendering any of these services to the company, then you are said to be disqualified. You cannot be appointed as an auditor of the company. If you observe these disqualifications, the major reason of giving disqualifications is to protect the independence of auditor. If auditor is independent, then he can express independent opinion. Understood? So users of financial statements can rely those audited financial statements. If he is not independent, he may end up with giving inappropriate audit opinion. Finally, investors, users of financial statements will be at loss, will be at risk. Is it clear, everyone? And the next important concept is resignation or removal of auditor. I forgot to tell you, if you take past 8 attempt question papers, you will find 5 attempt question papers with a disqualification question only. 5 out of 8 attempts, yes, there is a question on disqualification only disqualifications. So disqualification category is very, very important. First give priority to disqualification category. If you want to leave this chapter choice, you can leave it, but just study disqualifications. From disqualifications only you can expect 6 marks. Okay, next one, resignation or removal of auditor. Resignation, auditor can come out of audit office just by filing an intimation, but just by giving notice to 3 parties. One is company, the other one is ROC, and third party is C&AG. This is applicable only in case of government company, So notice shall be in ADT 3 form, and such notice shall be given within 30 days of resignation, and he has to mention the reasons why he is coming out of the office. Understood? Next one, removal. The effect of resignation and removal is, auditor is coming out of office before expiry of his tenure. Before expiry of his tenure, he is coming out of the office. That's what, vacancy in the audit office. Are you all getting my point? So removal of auditor, yes, who can remove auditor? 2 parties, company, NCLT. In company, again 2 parties are there, board of directors, members. So board of directors, by passing board resolution, can remove auditor? No. By passing board resolution, they can apply to central government for removal of auditor. So such application shall be filed with central government within 30 days of board resolution. Once central government approves removal of auditor, immediately call for general meeting. Within 60 days of central government approval, immediately call for a general meeting. In general meeting, obtain special resolution from members. Suppose board approval is there, special resolution is also there, sir, but central government approval not there, sir. So removal valid or invalid? Invalid. Suppose board approval is there, central government approval is also there, but members didn't pass special resolution for removal of auditor. In that case, removal valid or invalid? Invalid. Understood? So these 3 conditions should be satisfied, and in the same order these 3 conditions should be satisfied. First board resolution, next CG approval, and finally members approval. Next one, members. By filing special notice with company, they can remove the existing auditor. So section 115 special notice, yes, at least 14 days before AGM, members holding not less than 1% of voting power or holding not less than 5 lakhs paid up share capital. Any of these conditions should be satisfied. Any of these, one of these 2 conditions should be satisfied. That's why members holding at least 1% of voting power or 5 lakhs paid up share capital, whichever is lower, has to file a special notice with company. And such special notice shall be filed at least 14 days before annual general meeting. Now what company will do? Company at least 7 days before AGM should circulate members' resolution copy among the members. But before that, company has to send 1 copy to auditors of the company. And auditor is having a right to make oral representation as well as written representation. And it is the duty of company to circulate written representation along with special notice among the members of company. Of course, if auditor is abusing his right, if auditor is scolding someone intentionally, even without a mistake, without a qualification, then that concerned person or company can file an application with NCLT. If NCLT is satisfied that the auditor right has been abused, then NCLT passes an order not to circulate representation of auditor, not to yellow auditor to make oral representation in the meeting. And NCLT can order auditor to pay compensation, to pay damages to the company. So whatever expenses incurred by company by filing application with NCLT, yes, NCLT is having a power to order auditor to compensate the company. Understood? Next one, NCLT, removal of auditor by NCLT. In this case, either central government or any person concerned has to file an application with NCLT. Sometimes NCLT on suo motu basis. If NCLT is satisfied that auditor acted in fraudulent manner, auditor is not acting independently, auditor is acting in fraudulent manner, auditor colluded with management, auditor giving inappropriate opinion on financial statements. So if NCLT is satisfied, then NCLT orders company to change the auditor. NCLT orders company to change the auditor, and NCLT will impose a ban period on auditor for next 5 years. So next 5 years, auditor cannot act as an auditor. You know that practicing chartered accountant or a firm is disqualified to act as an auditor for the next 5 years in all companies in India. And NCLT may also order for section 447 punishment. Why? Auditor acted fraudulently, right? So punishment for fraud. Did you remember punishment for fraud? In Prospectus chapter, I discussed with you section 447. Just refer to the chart once. So this is all about resignation, removal of auditor. Next one, powers and duties of auditor. Powers and duties of auditor. So coming to the rights of auditor. Auditor is having a right to access books of accounts of company as well as subsidiary company. So why subsidiary company, sir? Subsidiary company auditor is different, no sir. Subsidiary company is having one auditor, holding company is having another auditor. Now holding company auditor, why he should have access to the books of accounts of subsidiary company? The reason, auditor, he will express opinion not only on standalone financial statements but also consolidated financial statements. So for the purpose of consolidated financial statements, auditor is having a right to access books of accounts of subsidiary companies. Next, auditor is having a right to receive notice of the company. Auditor is having a right to make inquiries into the company affairs, and auditor is having a right of lien. Of course, in professional ethics concept, auditor cannot exercise lien. See, he can exercise lien on the books of accounts of the company, on which for which the financial year company failed to pay audit fees to the auditor. But logically speaking, all the books of accounts, financial statements, books and records will be kept at registered office of the company. Then how auditor will get possession of those books of accounts, books and records? So logically lien right is not there, but as per this section, auditor can exercise lien right. Understood? Forget about logic, just remember the point in the provision. So he can exercise lien right on the books of accounts with respect to which his remuneration is outstanding. Next one, duties of auditor. So report on financial statements of the company. Whether financial statements are free from material misstatements caused due to fraud or error. Whether financial statements are prepared in accordance with applicable financial reporting framework or not. So he has to report. Next, he has to follow auditing standards. Next, he has to exercise reasonable care and diligence while conducting audit of company. And he is having duty to make inquiry into various matters. And accordingly, he has to report on those matters. Clear? Next one, auditor reporting fraud. One more important provision, reporting fraud. Here fraud, two types. Fraud 1 crore or more, amount involved in the fraud is 1 crore or more. Next one, amount involved in the fraud less than 1 crore. In case of 1 crore or more cases, if auditor is satisfied that in a particular area or in all the areas of the company, yes, fraud is there, and the amount involved in the fraud is 1 crore or more, then auditor has to communicate the same with board of directors of the company. If company is having audit committee, then to the audit committee. Sir, what is the time limit for making such communication? 2 days. Within 2 days of knowledge, of fraud, auditor has to communicate with board. Understood? Next, board has to respond to that notice within 45 days. So auditor has to report like this, nature of the fraud, area of fraud, amount involved in the fraud, and parties connected with the fraud. Now board of directors has to respond to that notice within 45 days. Next, auditor has to communicate the same with central government. He should send a letter to the Secretary of Ministry of Corporate Affairs, and he should send that letter within 15 days of a response from board or audit committee. In case of no response, then within 15 days of expiry of 45 days. So board or audit committee is having a time limit of 45 days to respond. If board or audit committee fails to respond, then within 15 days after expiry of 45 days, auditor has to communicate the same with central government. In case of fraud less than 1 crore, no need to communicate with central government. Just auditor just intimate the board or audit committee, and the board or audit committee shall make a disclosure in the board report. It's not audit report actually. Board report. So auditor has to communicate with board or audit committee within 2 days of knowledge of fraud, and board audit committee or audit committee shall make a remedial actions, shall take a remedial actions and shall disclose the same in board report. Is it clear, ma? Everyone? So just look into the material. Section 141 I completed. Qualifications of company auditor and who shall sign the audit report. So in case of firm or limited liability partnership, the partner who is a practicing chartered accountant can sign audit report, can sign financial statements on behalf of auditor firm. Understood? Next one, disqualifications. Each and every disqualification I covered. Just copy that notes. Understood? And one more point. So relative can hold securities up to 1 lakh face value of securities. Yes or no? Suppose after appointment, the holding value has been increased. Example, X was appointed as an auditor of C Limited and ex-wife is holding 90,000 face value of securities. 90,000 face value of securities in C Limited. One day C Limited announced bonus issue and the ratio 1:1. So original shares 90,000, bonus shares 90,000, total 1,80,000 face value of securities. Ex-wife is holding 1,80,000 face value of securities. Now in this case, 60 days time limit is given to the auditor to make a corrective action. So within 60 days, auditor relative, the person's relative has to reduce the holdings to 1 lakh. Within 60 days, if this action is taken, then he can continue as an auditor of the company, or else disqualified, and the consequence, vacancy in the audit office. Clear? Next one, direct indebtedness exceeding 5 lakh rupees. Indirect indebtedness guarantee amount, that is exceeding 1 lakh rupee. Both the cases disqualified. Next one, business relationship. It's very important to remember this list. Holding, associate, subsidiary of holding, subsidiary of associate, or company, subsidiary company, holding company. You have to remember that list. So in order to make question more tricky, so they will ask you these points. Understood? Next one, a relative is a director or KMP. Yes, this point was also tested in one attempt. A relative is a director of the company or KMP of the company, then also disqualified. Suppose relative is employee of the company. A relative is employee of the company, then disqualification attracts or not attracted? The answer is not attracted. Why? Employee is disqualified and relative who is a director or KMP of the company is disqualified. But normal employee, I'm the auditor and my wife is working as a clerk in that company or working as a cashier in that company. Now cashier is someone who is not a director, is not a KMP. Yes or no? Now in that case, I'm not disqualified. I can act as an auditor of that company. I can be appointed as an auditor of the company. Are you all getting my point, students? Everyone. If I'm an employee of the company, I'm disqualified. If I'm an officer of the company, disqualified. If my relative is an employee of the company, no disqualification. If my relative is director of the company, if my relative is KMP of the company, then I'm disqualified. Understood? Everyone. Next one, limit on audits, maximum 20 company audits. And he has not been convicted by a court. Understood? Suppose if he is convicted by court, offense involving fraud and a period of 10 years not lapsed, then during that period he is disqualified. In case of conviction by tribunal, then prohibition is only for 5 years. Already told this point just now. Removal of auditor by NCLT. A ban period of 5 years can be imposed. Next one, person shall not render services mentioned in section 144. If he render any of the services mentioned in section 144, disqualification. Next, so section 144 services, just give one time reading. Next, ceiling on number of audits. As I told you, while counting 20 companies, 4 companies are excluded. One is OPC, dormant company, small company, and private limited companies. Important note point, in case of private company, you can exclude that private company while counting 20 only when that private company is not committed any default in filing financial statements under section 137 or annual return under section 92 of the said act with the registrar. Suppose if this private company committed default in filing financial statements with ROC, then you cannot exclude from count 20. You have to include it in the count 20. Understood? So lot of examples are there. Just read one time so that you will get a clarity. Next one, audit committee applicability. I told you listed companies without limits. Public companies with a paid up share capital of 10 crores or more, turnover 100 crores or more, aggregate outstanding loans or borrowings or debentures or deposits 50 crores or more. Any one of these condition is satisfied, then such public companies, unlisted public companies shall constitute audit committee. And who can be the members of audit committee? Directors. Majority of the directors shall be independent directors. Manner and procedure of selection and appointment of auditors I already discussed with you. So who will make first recommendation and who will make further recommendation? Understood? Next, appointment of auditors. For this I gave you chart. First auditors, again 2 companies, non-government company, government company. Subsequent auditors, non-government company, government company. So just copy that chart, read that chart. Next one, duties of an auditor. As I told you, whenever auditor decides to resign from audit office, it is the duty of auditor to file a form with the ROC company, and in case of government company, C&AG. What is the applicable form? ADT3. And what is the time limit? 30 days of registration. 30 days from the date of resignation. Applicable form ADT3, time limit 30 days. And with whom he should communicate the matter of resignation? 3 parties. Who are they? Company, registrar, C&AG in case of government companies. Failure to communicate with these people, he will be punished. And what is the punishment? Fine. Not less than 50,000 rupees or remuneration, whichever is lower, and 500 per day of continuing failure. So first of all, minimum fine is 50,000 or remuneration. Suppose remuneration is 30,000, sir. Whichever is lower, so the fine will be 30,000 plus 500 per day during such default continues. 500 per day during such default continues. Suppose within 30 days he has to communicate with the registrar. Actually, he made communication on 40th day. How many days delay happened? 10 days delay happened. So 10 into 500, 5,000 plus 30,000, 35,000 rupees is the punishment. And this fine amount is subject to a limit of 2 lakh rupees. Maximum how much? 2 lakh rupees. So wherever you're going through fines, punishments, just write it on a separate note. Make it a separate note. No need to copy entire text. Just like this. 50,000 or audit remuneration, whichever is less, plus 500 per day during such default continues. During such default, maximum 2 lakh rupees. So make a note of these points. So you will feel comfortable while revising those fines, penalties. Understood? Next one, applicability of rotation of auditors. Here also limits are very, very important. Listed companies without any limit. Unlisted public companies, whether paid up share capital 10 crores or more, or borrowings from public financial institution, banks, public deposits 50 crores or more. Private limited companies, paid up share capital is 50 crores. The next limit is similar. And this provision shall not apply to OPC small companies. Also, rotation shall not apply for government companies. In case of government companies, C&AG shall appoint a new auditor every year, or he may appoint an existing auditor for the next year also. Understood? Where appointment happens once in every year. In case of non-government companies, appointment happens once in 5 years. So once auditor is appointed, he can continue audit office till the conclusion of 6th AGM. Coming to government company, every year C&AG shall appoint auditor. Every year appointment. And what is the time limit for appointing subsequent auditor in case of government company? 180 days from the commencement of financial year. Manner of rotation. An individual as auditor can be appointed for 1 term of 5 consecutive years. A firm of auditors 2 term of 5 consecutive years. Sir, here more word is there, sir. Just read the provision. Shall not appoint, shall not reappoint for more than. Shall not appoint or reappoint for more than. Understood? Next, cooling period. Once tenure is completed. So 5 years cooling period is compulsory. That means during that 5 years, he is not eligible to act as an auditor of the company. Sir, during these 5 years, can he provide, prohibited services mentioned in section 144? Yes. There is no restriction on section 144 services. 5 years, you cannot act as an auditor of the company. So during these 5 years, you can be appointed as an internal auditor, or you can provide some financial services, investment banking services, investment advisory services to the company. So there is no restriction on prohibited services during this period of 5 years of cooling period. 5 years cooling period. Understood? Everyone. Next one, principles of rotation. I already told you. Common partners, same network, same brand, common ownership. Yes, all these firms are disqualified. Not only retiring firms, but also incoming auditor is also said to be disqualified. Next one, procedure for removal of auditor. I discussed with you 3 conditions compulsory: board resolution, central government approval, special resolution. Time limits also very, very important. And one time, a question came on this concept. The question is like this: board of directors, after passing board resolution, called for general meeting for removal of auditor. In that general meeting, members passed special resolution, and that special resolution was passed before obtaining central government approval. Now, is that removal valid or invalid? And this question was asked for 4 marks. So the answer is invalid. You will get 1 mark, and you need to write justification. You need to write provision, and what condition gets violated. Write that in analysis part. Conclusion part, yes, the removal is invalid as company removed auditor before obtaining approval from central government. Now you will get 3 to 4 marks for this question. Next, procedure for removal of auditor by tribunal. As I already told you, tribunal on suo motu basis, or tribunal based on application by central government or any person concerned, if it is satisfied that auditor has acted in fraudulent manner, if auditor has acted in fraudulent manner or colluded in any fraud with the directors or officers of the company, then tribunal may direct company to change its auditors. And if the application is made by CG and the tribunal is satisfied that any change of auditor is compulsory, required, it shall make an auditor that he shall not function as an auditor within 15 days of receipt of such application. So tribunal, within 15 days of receipt of application from central government, tribunal orders company, tribunal pass an order that auditor should not continue. Auditor is disqualified, and central government may appoint another auditor in his place. All this will take place only to protect the public interest. Understood? Next one, prohibition on further appointments. I told you, tribunal will impose a ban period of 5 years, and tribunal will also levy, such auditor is also liable for action under section 447. So summary chart is there. Just go through this summary chart once. Next one, powers of an auditor. Right of access to the books, including subsidiary company books. Next, right to obtain information and explanation, right to receive notice of general meetings, and right to attend general meeting, as well as duty to attend the general meeting. A right of lien, right to report to the members of the company on accounts examined by him. Next one, duties of the auditor. Duty to report, as I already discussed with you, duty to report and duty to make inquiries into the various matters. You can see here whether he has obtained all the information and explanations to which to the best of his knowledge and belief were necessary for the purpose of his audit, and if not, the details thereof and effect of such information on the financial statements. Next one, whether in his opinion proper books of accounts as required by law have been kept by the company. That means all the applicable provisions related to books of accounts. Books of accounts shall be maintained in accrual system, double entry system. Understood? And books of accounts shall exhibit true and fair view. Whether these conditions satisfied or not, yes, auditor has to report it. Auditor has to report it. In case of any qualifications or remarks, then he shall state the reasons in the said report, and auditor report shall also state these matters. Next one, whether the report on accounts of the branch office of the company audited under subsection 8 by a person other than company auditor has been sent to him. So branch audit report, whether company made available the branch audit report to the company auditor or not, and how company auditor dealt with branch audit report, how he considered it, like that. Whether company balance sheet and profit and loss account is in agreement with books of accounts. So balance sheet, profit and loss account prepared based on books of accounts or not. Next, whether in his opinion financial statements comply with the accounting standards. Financial statements complying with accounting standards. Next one, observations or comments of the auditors on financial transactions or matters which have any adverse effect on functioning of the company. So you need to report the observations which affects the functioning of the company, and whether any director is disqualified. So if disqualified, comment. No disqualified, no need. Any qualification, remark, adverse remark relating to the maintenance of accounts and other matters connected therewith, and whether company is having adequate internal financial controls with reference to financial statements in place and their operating effectiveness of such controls. So auditor has to comment on this matter also, and such other matters as may be prescribed. So don't expect that ICA will ask this much lengthy question for 4 marks, 5 marks. They will take just one provision. On that provision, they will ask you a practical question. So if you had knowledge of this provision, you can answer those questions. So knowledge sake, read all the contents of this chapter, all the points. Yes, of course, I agree. This is a lengthy chapter. The time required to complete this chapter equal to time required to complete charges, deposits, dividends, as well as classes, preliminary chapter. Yes, ma'am. So while reading this chapter, whatever time is required, with this time, you can at least finish dividends chapter as well as charges chapter. Dividends and charges put together, you will get 15 marks. Audit and auditors chapter, you will get 6 marks. So you have to make cost benefit analysis, and you have to allocate time, in a proper manner. Then only we can score more marks in the examination. Is it clear? So each and every subject, each and every topic, before you start preparation, before you start revision, just make cost benefit analysis. So what is the time required to complete this chapter? What is the time required to revise this chapter? And what is the time and how many marks I can expect from this chapter? So just make analysis of it and just go with preparation. And one more point, almost we are nearing to the, we are at the examination only, near to the examination only. So right now it's not correct to tell me, but let me tell you. See how much content you can revise a day before examination. You'll have only 1 day before examination. How much content you can revise on that day? Just prepare for that content only. Suppose now you are having plenty of time, you are preparing all 15 chapters, and on a day before examination you have time only to revise only 10 chapters. Now what is the use of preparing for those 5 chapters? Understood? So focus. So what is your stamina? First evaluate yourself. How much content you can revise a day before examination, that much content you have to prepare before examinations, 1 month or 2 months before examinations. And it should be at least 3/4 of total syllabus. 120 marks question paper, 3/4 means 80 marks. Attempting 80 marks, you can easily expect exemption. So don't think that if you write 100 out of 100, then only you'll get 60. Some students will attempt 100 marks and they may end up with getting 20, 30 marks. So here, attempting more number of marks is not important. Attempting more questions which are correct is very, very important. Is it clear? Okay, next, duty to sign audit report, duty to comply auditing standards, duty to attend general meetings. So these are the duties of auditor. Next, duty of auditor in reporting fraud. So 2 categories, 1 crore or more, report to the central government. Less than 1 crore, no need to report to central government, just communicate with the board of directors. Board of directors shall disclose the same in board report. Next one, the next most important topic from limits point of view is cost audit. Limits point of view. And this is a tricky concept, somewhat, applicability. Understanding applicability of cost audit, applicability of cost records is something tricky. Just follow me for the next 10 to 15 minutes. I'm going to conclude this chapter marathon. See, applicability of cost records, applicability of cost audit. Here, industries are categorized into three categories: regulated sectors, non-regulated sectors, others. Regulated, non-regulated, others. Understood? Now industry, a company is engaged in the product, is engaged in multiple products. Some of the products are falling in regulatory, few non-regulated, others are other categories. So in that case, cost records is mandatory, cost audit is mandatory to the companies which has satisfied the conditions. Suppose a company is not in regulated, a company is not in non-regulated sectors, company is in other sector, no need of cost records, no need of cost audit. So company falling in either regulated or non-regulated, satisfying the criteria, has to maintain cost records, has to conduct cost audit, should have cost audit wing. So first of all, applicability, looking at the applicability, just observe this chart. Applicability for maintenance of cost records: domestic or foreign company which is engaged in production of goods or providing services listed in table A or table B. Table A regulated sector, table B non-regulated sector, and having an overall turnover from all of its products and services 35 crores or more in the immediately preceding financial year. Now this year maintain cost records. Now you have to pay a lot of attention to understand this point. Suppose company A Limited is there, it is neither falling in category A, it is neither falling in category B. Let me change the name of company to avoid confusion. Company C Limited is there. So it is engaged in production of goods, it is engaged in providing services, but this production of goods or providing of services is not covered in category A, is not covered in category B. So neither category A nor category B, and it is having a turnover of 110 crores. Now cost records applicability, is cost records mandatory or not mandatory? Answer is not applicable. Another company B Limited is there, D Limited is there, it is falling in category A and it is also producing other goods, others which are not falling in category A, category B, and total turnover is 40 crores. Now is applicable, applicability of cost records, applicable or not applicable? Answer is applicable. Why? It is engaged in category A and its turnover is more than 35 crores. How much it is? More than 35 crores. Getting my point, students? Everyone. Another company E Limited is there, it is engaged in a goods mentioned in category B. Next one, others. Now total turnover of goods of B category as well as other goods, other services 50 crores. Then also cost records are applicable. Then also companies are required to satisfy this section, this provision. Clear? First of all, it should be engaged in table A or table B. Second one, its turnover from all the products, whether it is category A product or category B product or other products. If turnover is 35 crores or more, then it is required to maintain cost records. Now just solve these various questions. If you observe carefully, table A means category A, category B. So total 20, less than 35, less than 35, less than 35. Okay. If you check like that, it is a wrong. Why? You have to consider total turnover. 30, yes, less than 35, cost records not applicable. Here it is more than 35, cost records applicable. 40, more than 35, cost records applicable. More than 35, applicable. More than 35, applicable. Sir, more than 35 but not applicable. Why? Because it is neither engaged in table A nor engaged in table B. Understood? First of all, it should fall either in table A or table B. Next, its turnover is equal to 35 crores or more than 35 crores. Then only cost records are applicable. Next, applicability of cost audit. This is another tricky point. Just observe carefully. Overall turnover of the company from its products and services during immediately preceding financial year 50 crores or more end, it's not or end. Aggregate turnover of individual product or service covered in sector 25 crores or more. See, overall turnover means what? Category A turnover, category B turnover, or table A turnover, table B turnover plus table C others. Next one, aggregate turnover of individual products services covered in the sector. Which sector? Regulated sector. 25 crores or more. Category A, 25 crores or more. Suppose sir, one condition satisfied, sir, second condition not satisfied. Cost audit is not mandatory. Cost audit is not applicable. If two conditions are satisfied, then cost audit is applicable. What are those two conditions? Overall turnover 50 crores or more. Aggregate turnover of individual products and services covered in this sector 25 crores or more. Now coming to non-regulated sectors, A plus B plus C. Aggregate of A plus B plus C. That means table A, table B, table C is 100 crores or more. Next one, aggregate turnover from table A plus table B 35 crores or more. In that case, table A products, table B products are subject to cost audit. Here also you can see both the conditions should be satisfied, or else cost audit is not applicable. Now with this information, let's solve these cases. I'm having answer right itself, so don't look at the answer, follow my explanation. Table A 10, B 10, overall A plus B 20. What is the total turnover? 30. 30 means less than 50 crores. So less than 50 crores, no need of cost audit. And it is also less than 35 crores, so no need of cost records. Cost records are also not required. So first we'll look at the total turnover. So this is our first priority. Second priority, table A plus B. Understood? So here it is 40. That means more than 35 crores. So cost records mandatory. Understood? And it is since less than 50 crores, cost audit is not mandatory. And moreover, it is engaged in table A, table B. Next one, 40. More than 35 CR, so cost records mandatory. Less than 50 CR, so cost audit not applicable. Again here 40. More than 35 crores, cost records mandatory. Less than 50 crores, so cost audit not mandatory. 50 crores, okay. So it is more than 35 crores, cost records mandatory. And 50 crores, it is falling in this category. Just observe 50 crores. 50 crores or more. Regulated sectors, just observe carefully. So 50 crores or more. So here condition for cost audit is satisfied. And you need to check total turnover from table A plus table B. You need to check table A plus table B. So table A plus table B 35, which is more than 25 CR. So two conditions satisfied. So table A products cost audit is mandatory. Yes, but only for table A, not for table B. Sir, for table B cost audit is applicable if overall turnover is 100 crores or more and turnover from A and B is 35 crores or more. Understood? Next one, 40 crores. So audit not mandatory, cost records yes. Why? It is engaged in table B. 110 crores, cost records mandatory. Fine. Now you need to check whether it is falling in category 1 or category 2. So what category 1 is selling? 50 CR overall turnover, 25 CR regulated sector plus non-regulated sector turnover. So if you observe carefully, 110 crores, that means it has satisfied two categories, whereas category 1 not satisfied, category 2 not satisfied. Why? In category 2, aggregate turnover A plus B should be greater than or equal to 35 CR, whereas here the turnover is 30 crores. So here it is less than 35 CR, however it is more than 25 CR, therefore only A is compulsory, only A, table A product cost audit is compulsory. Next one, 110 CR, both cost audit as well as the cost records are applicable. Check the turnover from A plus B. A plus B turnover, yes, it is greater than or equal to 35 CR. So both table A and table B products, cost audit is mandatory. Next, 100 crores, cost audit required or not required. Look at the A plus B turnover. it is less than 25 cr, less than 25 cr. That means, this condition not fulfilled. Which condition? This condition not fulfilled. Yes, of course, these two conditions fulfilled, but the point is, I'm telling you, is both the conditions should be satisfied. Overall turnover and aggregate turnover of A and B. If these two conditions are satisfied, then some cases table A audit is compulsory, some cases table B audit is compulsory. So since aggregate turnover of table A plus table B, it is less than 25 cr, cost audit is not required. So 40 crores cost records required, and since it is less than 25 cr, sorry, less than 50 cr, cost audit is not required. Next, 48 crores cost records compulsory. Since turnover is less than 50 crores, overall turnover is less than 50 crores, cost audit is not mandatory. Sir, here limits crossed. No, sir, here limits crossed. No. I need to check overall turnover. So let me give you one simple chart for remembering these points. Applicability, section 148 applicability, cost records, cost audit, cost records, cost audit. Cost records engaged in A or B, overall turnover 35 cr or more. Overall turnover how much? 35 cr or more. Next, cost audit to table A, plus table B. When and two conditions are satisfied, table A products require cost audit. One is overall turnover 50 crores and A plus B turnover 25 crores. In that case, table A, audit of products covered in table A is compulsory. Next one, in this case, overall turnover 100 crores and A plus B turnover 35 crores. In that case, audit is mandatory for both A as well as B. Understood, everyone. So simple only, but many will confuse while reading these limits. So just copy this chart and try to solve these cases on your own. So with this, audit and auditors marathon also completed. All the best for your upcoming examinations.